Start. Thank you, everyone, for joining us this afternoon. We're going to have a panel discussion today looking at climate investing in 2024 and beyond. Again, thank you for everybody attending and for our panel today. We're going to be discussing a few topics covering ESG and investing and a few other things. And I do want to leave some time for questions and answers. We have a great panel and knowledge base up here, so we'd love to get some engagement from everybody as well towards the end. I'm going to let you guys introduce yourself. We'll start out with you, Dan, and we can walk through a little background and so people know who we're talking to.
Good afternoon. I'm Dan Leibovitz, CEO and co-founder of Green Impact Exchange, which is a startup stock exchange for companies looking to dually list for showing investors their commitment to green and green transition.
I'm Bernard Tan. I'm the CEO and co-founder of RE Royalties. We are a royalty-based financing company. We also trade on the TSX Venture and also the OTCQX. So we're both investor and also investee.
Good afternoon, everybody. My name is Joseph Lukoski, and I'm the managing partner of Lukoski Brookman. We are a corporate law firm here in the New York, New Jersey area, focused in the capital markets and hyper-focused in the micro-cap area, financings and mergers and acquisitions. We have 45 attorneys, and like I said, this is our space and our community and our ecosystem.
I'm Sean Severson, co-founder and president of Water Tower Research and head of sustainable investing. So I'm going to go ahead and jump into some questions, guys, so we can get started. First one is a very broad question, so I know we can take it in a lot of directions, but wanted to get an overview of the current investment environment as you see it in sustainability and climate tech, because I think it offers some unique aspects. It's been a tough road over this year for a lot of clean tech companies, ups and downs, 2021, 2022, all over the place. But it's created a unique opportunity for investors, given where we are today, and wanted to talk to each of you about what you think some of the big themes are.
Okay, well, so I'm sitting next to you. I'll start.
Yeah.
I think that, look, there's a shift going on. If you compare to Internet 1.0 and Internet 2.0, what I think you're seeing Green 1.0 shifting into Green 2.0. That there was a lot of enthusiasm, a lot of great ideas, a lot of people were throwing money at it. There was, trillions and trillions of dollars being invested in the green space, and I think that there's been some pullback and reassessment as to whether or not each of those investments was viable and the best way to go. And what you're seeing now is the companies that had the solid ideas and the solid backing are thriving, and the ones that were tenuous are not. And you're going to start to see, my prediction is you're going to start to see an upswing.
Yeah, it is, as you say, Sean, it's quite an interesting market. I started my career at the height of the dot-com crash. But so it was a very tough environment at that time as well. But some great companies emerged out of the crash. Big those names, came out of it, and really one of the things in this sector in the sustainability side is that long macro trend. That eventually, this won't be the last boom, it won't be the last sort of bust, but over the long term, that's really where I think from a sector standpoint is really leaning towards. Now, it doesn't feel good for companies such as ours or issuers sort of in the downstage, but really that's really when that old cliche, it's steel's made when fire's the hottest. So I think a lot of companies are going to come out of this stronger, but long-term outlook is definitely very bright.
Yeah, I agree, both of you. But then one thing that you said that resonates with me is the 1.0 to 2.0 analogy. For us on the legal end, it's a little bit different. So we're not so much in the day-to-day of making investment decisions, but we're around investors and investment bankers and those who make those decisions, and really hear a lot about what concerns them in this area and other areas. One thing that came to mind when you were talking about this sort of full circle dynamic in this space is in 2018, we took a company from the OTC to NASDAQ called Blink Charging. Some of you may know that company, may know that deal. That deal raised a lot of money. When we did the NASDAQ deal, I think it was $54 million with all of the warrant coverage, which came out really, really well. It really did nothing for a year or two, or at least as far as the trading fundamentals went, and investors were, lukewarm on it. All of a sudden, President Biden got elected in 2020, and the thing shot up. All the money that was coming into the market and the new initiatives and the new administration. And then recently, it's come full circle. It's come back down, both in trading and interest and dollars from investors. But it goes to your point that it's a full circle process, and better investments, better companies are going to come out of this. But that's a hard example that we see where we've lived that cycle of getting there, boom, to quasi bust, and now getting back on the track, an upward trajectory, and hopefully into 2024.
Because it's become a targeted area where if you're just in the space, it was a rising tide, right, for quite some time, and we see that every day with investors really trying to sort through real business models, looking at fundamentals, like you said, Bernard. Good companies that are able to shine now are really coming out. It's not just enough to call yourself a clean tech company or a climate company. You really have to have business model and something that works. And it's also interesting too overall because we're hitting some of those commercialization targets that a lot of people set out a couple years ago too, right? If you look back and you took EV companies and you added up all their market share, there'd have to be a 300% market share because they're all going to dominate the space. And so now it's created some interesting some pullbacks, and some probably should have come back in, which they have, and others are now ready. It's been a reset, I think, and creates an interesting opportunity for investors.
I mean, if you look at trends are very helpful because Bernard was talking about the dot-com bust. If you looked at what was your web strategy, that was the question in the late 90s.
Eyeballs.
What was your social strategy? That was 2010. What's your and Carly, what's your AI strategy? Right, like everybody's got AI. Well, green was in that line, and what was your green strategy? And now each of those industries, the web grew up to be, Amazon and Google and all the FANG stocks, and social grew up, and green will grow up. It's growing up. It's going to take time.
I think also just on the regulatory side, just to bring it back for 1 second, as a lawyer, we think about ways to, help companies effectively disclose what they need to disclose, be transparent to investors, don't over disclose, don't create work when there doesn't need to be any, but to be transparent. And one of the things that I was thinking about even this morning was I read an article that came out about this concept of AI washing, and you mentioned AI in companies' disclosures and overhyping the AI. Well, this is what the this industry went through years ago, and I think it's sort of settled down where people have become more realistic. Years ago, whatever time period that was, everybody just would mention the word green to try to get some attention. And the markets got more mature, and now they see through that, and they want to see really what's behind that sort of green phrase or green disclosure, and really looking to see what's there. So it's going through right now with the AI side, but it reminds me of what happened years ago in the green space.
This too shall pass.
Well, going back to the green space, and let's break out ESG specifically, because you had a lot of different terminology that people would use. Is it, you're really an ESG company? Do you qualify as ESG, or you just you have great tailwinds that are related to clean tech? So I think let's talk a little bit about what ESG means today, and particularly for small cap companies. And again, I don't know if you're more of the regulatory. Well, actually, I think from your perspective and being able to pre-qualify, maybe talk a little bit about what the exchange, your goal would be, and how that fits in.
So I'm on the record as ESG is a terrible acronym because it tries to boil the ocean, and it just invites people who want to pick a fight with you to find something that they don't like, and they can use that to beat you over the head with.
Right.
So start with the disaggregation, I think is key. But and the second thing I will say, which is one of my bold prediction, is that sustainability is becoming the new ESG. People are cramming everything they used to talk about with ESG. Well, you can't say ESG anymore, so now I'm going to talk about how I'm a sustainable company. I have a sustainable DEI strategy. I have a sustainable energy strategy. And I have a sustainable governance strategy. At a certain point, the word sustainable stops meaning anything, and it becomes exactly what ESG was. So start with that. But in terms of what does it try to do? It tries to identify things that are different from the ordinary way of doing business. I'm going to focus my my activities in an area that is sensitive to the impact I'm going to have on the environment, and make sure that I'm resilient to the impact the environment is going to have on me. I'm going to focus my business in an area where I'm sensitive to the impact I'm having on my stakeholders on the social side, and also that I'm resilient from avoiding the kinds of mistakes that, like, the University of Pennsylvania and Harvard are going through today, literally, with whether or not their leadership is quote unquote sensitive enough. And the same thing with governance. I'm going to show that I'm treating my workers fairly, that I'm pay equity, all of these things. It's a lens for focusing otherwise non-financial activities into things that investors can look at and discreetly understand. Is that the most efficacious way to communicate with investors? I'm not sure, because again, you're trying to boil the ocean. But I think it is useful to say it's not all about just that bottom line number. That bottom line number is composed of a bunch of things. You need to think about what are the risks and threats to that bottom line number that come from environment and social and governance.
Just to add to that, I agree. But where we sit in this sort of micro and small cap land, there's less discussion of all of that, because the companies are smaller. We see it in the bigger deals when there's bigger institutions and asset managers, sometimes on the private side. But in the true, micro cap land, we see less of that forward thinking and preparation for what's coming down the pike. It's interesting. I woke up this morning. The first thing I saw in my news feed was that the SEC announced that they're finally going to take a vote on some of these proposals in April 2024, which has kind of been hung out there and not sure what was going to happen. So, and not only that, obviously this is, as Dan said, a lot of interest and activity, over 15,000 comments on these proposals, which is an extraordinary number of comments, and some in favor, some against. But finally, in April, there's going to apparently be some more clarity on what is expected for companies to move forward with their plan to disclose and communicate.
For us, it's actually a tool. I know from a lot of companies, they use it more as a marketing. But for us, it's one of the tools that we use for screening our investments. And generally, the E can sometimes be quite obvious because of some of the things we focus on, but sometimes not so much. So I can definitely understand sometimes the accusations of greenwashing. And I work with personally use a large bank on my personal side, and when they try to sell me green products, typically it's not very green,
Right.
other than the marketing material, perhaps.
Recycled paper.
Yeah. Or they send it electronic.
Yeah, of course.
Yeah,
Right.
yeah, but one of the things that we use it on, sort of us corporately, is really using it as a screen to make investment decisions. And I would say generally the biggest risk in ESG is not the E or the S, it's the G, which is, I think from our sort of investment screen, working with public companies give us that extra layer of comfort that perhaps private investments don't, because it's difficult to kind of see through. Whereas if you're dealing with a public company, whether you're large, small, micro cap, there is a regulatory governance structure, at least bare minimum, that they have to meet. So for us, that's, I would say generally all the deals that we don't do fail mainly because of the G.
Yeah, I agree with that. We see it on the G side too, and that's an excellent point. We talked about this the other day briefly. For us, it's the G is the general G. Do you have general G structure? And then comes along with that is everything we're talking about here in ESG. It's an additive or supplemental piece to what we would consider capital G in governance, and that's how we see it in the microcap world.
I hate to say that we're all going to agree on this, but actually, I think it's all G. The E and the S are promises that are only enforced if you have the governance infrastructure.
Yeah.
And at GIX, that's one of our core observations and pieces is that what you say matters, but what you have to back up what you say is what matters more. And when we talk about the governance structures, do you have board level buy-in? Do you have management level buy-in? But also, do you have employee support for it? We call it from the boardroom to the loading dock, because a lot of time, the guy who runs the loading dock or the person who's in charge of the production facility says, "I get all of that good stuff, like that environmental crap. Thank you. But I don't have the resources. I don't have the training. I don't have the time. I don't have the people. And I'm being measured on how many trucks I roll or how many widgets I put off the production line. So none of that stuff is being compensated. So I can't pay attention to that now." And everything that you said you were going to do with the best of intentions just fell apart because your governance structure wasn't in place to enforce that.
Gentlemen, I'm sorry to cut you off. We have just a few minutes here. I wanted to go to the audience, see if there are any questions from anyone.
please.
John, I know we have one from the virtual.
We do. So, question from the online audience. Somebody's asking, what's the best way for a small microcap company who is doing the right things in the ESG space to get recognition from the investor community?
Well, I'm going to plug GIX
Yeah,
for that
you got
one.
a perfect answer for that.
The idea that when we started the exchange was exactly that there are companies who are struggling to get attention, who want to be able to focus the story on what they're doing right. If they qualify for listing, even at microcap level, qualify for a NASDAQ listing, they qualify for a GIX listing. So I would have them call me.
Being a small publicly traded company in the ESG space and struggling to get ESG attention, I would say really, just finding a network of champions. That's why we work with Sean and his team. Would be interested to learn more about the GIX, obviously, and finding that community, because that community, I would say, there's many more companies in that same community, and really a conference like this allows companies that are along that same path to advocate for each other. And that's really sort of, I would say it's a long journey, because using my example earlier, my personal bank that I deal with on a personal level, they're selling me product that isn't naturally green, but eventually working with different groups, hopefully those products will become a lot. That's really what I'm.
Bernard, thank you very much. Sean, Dan, Bernard, Joe, thank you very much for your time. I think we are at our limit here. So again, thank you.
Thank you.
Thank you.
Oh, okay. Great. Thanks.
Yeah.
next presentation is going to be from Eric Goldstein. He's the Vice President of Investor Relations at SES, which trades on the New York Stock Exchange under SES. So we welcome him. He's a good friend of ours.
Excellent. Thank you, Charlie. Appreciate it. Just want to say thank you to the Water Tower team for having us here today and hosting this great event. So as Charlie said, I'm Eric Goldstein. I'm VP of Investor Relations for SES. We are a lithium metal battery company, and really at the heart of it, we're a material sciences company. We're working on lithium metal anodes for batteries for electric vehicles, for urban air mobilities, for drones, things like that. At the heart of what we're doing, we are effectively a weight reduction technology. Our technology is a cousin, we would say, to lithium ion. And weight reduction in automotive basically means for an ICE vehicle, take out weight, you're getting more miles per gallon. For an electric vehicle, you take out weight, you're getting more range. Or you could use a smaller battery, take out cost for the same amount of range. And that's effectively what we are working on. The company was founded in 2012 by our CEO, Qichao Hu. He started the company out of a research lab at MIT. He was originally working on more of a solid state solution, but came to the conclusion that couldn't be scaled. In 2015, he developed a proprietary solvent and salt liquid electrolyte, which is non-flammable and very stable on lithium. And that is the heart of the technology that we have today. The heart of SES is really in the electrolyte. General Motors invested in our company for the first time in 2015. And we've been working very closely with GM since then. We have investments from Hyundai and from Honda as well, and we have joint development agreements with them as well. So we have 3 big car companies that we're working with. Our headquarters are in Woburn, just outside of Boston. That's our headquarters, and we have basically labs there, and our electrolyte team is headquartered in Woburn. We have 2 pilot facilities, pilot scale facilities, both in Asia. One is in Shanghai, where we work with Honda. Another one in South Korea, where we work with GM. And there's a second facility in South Korea where we work with Hyundai. Why is lithium metal important? And as we think is really the next big thing for battery technology. Lithium is the lightest metal on the periodic table. So we're basically replacing the graphite that's found in a traditional lithium ion battery with lithium metal. And that's where you get the big weight reduction and you get a big increase in energy density. So just some quick investment highlights. So we are a lithium metal battery company with leading energy densities, and we have comprehensive supply chain partners. Our manufacturing process basically takes advantage of very cost-effective and conventional industry processes. So most of what we're doing is almost identical to the way a lithium-ion battery is put together. We have 3 A-sample joint development agreements, one each with GM, Hyundai, and Honda. We've said we are going to transition, and we announced we are transitioning to B samples with 1 OEM, and that's a process that's happening right now. We're collecting and building AI algorithms to monitor the health of our batteries and to enhance safety. We have a very experienced management team with decades of battery development experience that have come from the lithium-ion industry, have come from national labs, really talented people. And we believe that we are funded to commercialization. We ended the third quarter with approximately $342 million of cash. So as you can see here, just looking at a brief history of battery technology, basically every 10 to 20 years, there have been kind of breakthroughs in batteries. And the key is that every technology is basically lighter and smaller compared to the technology that preceded it. And we think lithium metal is going to be the next big thing. So our batteries are denser on a watt-hour basis. We think they're very scalable, lighter, safer, faster, and smarter. As I mentioned, some of the things we're doing with our AI algorithms. We're backed by many strategic partners. General Motors since 2015. Hyundai, who has invested in the company several times, and we work very closely with them. And the partnership has the potential to expand beyond just electric vehicles. And Honda, who invested in the company for the first time in 2022, they were actually the biggest investor in our pipe after they had been testing our batteries for a year before that. Our largest shareholder is SK, the big Korean battery company, and we have investments from several other companies, including the venture capital arm of LG. In the interest of time, I'll just highlight three people. Obviously, our CEO, Dr. Qichao Hu, who founded the company 12 years ago. Rohit Makaria. Rohit is our Chief Strategy Officer. He worked at GM Ventures in 2015. He worked at GM for over 19 years, but was at Ventures in 2015, and he led the actual initial investment on behalf of GM in the company in 2015. He was on the board of SES when it was a private company, and he's now our Chief Strategy Officer. And Dr. Hong Gan is the third person that I would highlight. He runs our electrolyte team. And as I said, the electrolyte team is really the heart of SES. He came from Brookhaven National Lab, and he's at our headquarters up in Woburn. So here's just a brief overview of our footprint. So as I mentioned previously, headquarters in Boston. We have 2 pilot scale facilities where we're making, between, depending on the facility, between 500 and 1,000 large batteries per month. So batteries that range from 50 amp hours to 100 amp hours in terms of capacity. Here's an overview of, if you look on the left side, what a conventional lithium-ion battery looks like. And then if you look all the way on the right, you could see the SES approach. So basically, there are 4 key components to a battery. At the bottom, if you look on the left at the bottom, you have a cathode. You have a separator. In the middle, you have the anode at the top, and then there's the electrolyte in between. The electrolyte being the mechanism by which lithium ions travel back and forth between the cathode and the anode. If you look at our approach, we're basically replacing all those big black bubbles, circles on the left, which represent graphite, with a thin piece of lithium metal, about 20 microns in thickness, so thinner than a human hair. And what enables the lithium metal to work is our electrolyte. And so when you just looking visually at it, you could see we can make a much smaller, lighter battery. Just moving on, this just breaks down our approach in a little bit more detail. You could see we have a wide format lithium metal anode. The lithium metal is basically extruded from a lithium ingot until it's down to about 20 microns in thickness, and it's a pretty wide format. We then laminate that onto a copper foil with proprietary equipment that was developed by the company, and that's how we form the anode. There's a composite anode coating, which is proprietary to SES. We're using a polymer-based separator, which is a very common separator, similar to what you'd find in a lithium-ion battery today. And we're applying a solvent and salt, proprietary liquid electrolyte, which is non-flammable and very stable on lithium. And then we're using high-capacity anode cathodes. and we're agnostic in terms of cathodes. We work with our partners on either high nickel cathodes, which are found in most EVs that you'd find in the United States today. And we work with LFP cathodes, which are lower energy density, which are maybe more prevalent in China, but they're finding their way over here as well. And so we're agnostic on the cathode side. So we have an innovative and proprietary electrolyte. It's a high concentration solvent and salt liquid electrolyte. It's kind of the opposite of the electrolyte that you would find in a conventional lithium ion battery today. The solvent is coordinated by the salt. There are no free solvent molecules. And importantly, the solvent molecules are non-volatile and non-flammable. So this is just a picture of kind of the type of reaction that you get inside a battery cell. So our proprietary electrolyte effectively changes the morphology of what you'd find in a cell. So our CEO would call it, we get what's on the right, which is more of a mossy lithium, which isn't really dangerous to the health of the battery, compared to what you don't want to get. And what we have solved for is you don't want to get what's on the left side, which is a dendrite or a sharp needle-like structure that can form. And if it grows from the anode into the cathode, so pierces the separator into the cathode, you'd get a short in your battery. Just looking at lithium metal makes nickel-free chemistries more competitive. So basically, what this chart is just showing, if you look on the all the way on the right, the green circle on the right is the energy density of our lithium metal cell paired with a high nickel cathode. So we're roughly around 400 watt hours per kilogram. And if you look in the middle of the chart, where today's lithium ion batteries paired with a high nickel cathode or around 260 watt hours per kilogram. So we're roughly about a 50% increase. But what's interesting is that when you pair lithium metal with LFP, which is a lower cost material, when you pair lithium metal with LFP, you could actually get energy density that's slightly higher than today's lithium ion batteries paired with a high nickel cathode. So slightly higher energy density, but less money. These are our three partners. As I mentioned previously, we have joint development agreements with General Motors, Hyundai, and Honda. GM we work with in South Korea. We've been working with them since 2015. They've invested in the company multiple times. GM has an appointed director that serves on the board of SES. Hyundai has invested in our company multiple times. And we have a joint pre-production facility in South Korea. Honda, after testing our batteries for more than a year, was the biggest investor in our pipe. So that's going back to 2022. They invested $75 million after working with our batteries for about a year. They have become a real mentor for SES. The Japanese, historically have a different type of relationship in terms of how they work with their suppliers. They have named us one of their three key battery partners for the future, where technically they would call us their semi-solid state battery partner. So they're helping us today. They spend a lot of time in our Shanghai facility. They're helping us design and spec equipment for a line 4, which we've said will be for B samples. And that should be up and running in 2024. So this is just a slide that just depicts the development time frame for new battery technology. And this is actually this is the process for any new automotive technology. You're going from R&D into A sample, B sample, C sample. Just most automotive technologies don't take 10 years. Battery development is about 10 years. If you're working on a new seat motor or something, that could be pretty quick. But with batteries, obviously new technology, safety is critical, life cycle is critical. There's a lot of different variables. It takes a long time to just go through this process. So right now, we are between, kind of 3 and 4. So we have 3 A sample JDAs. We've said we're entering B with one of our OEM customers right now. And that'll probably be a 12 to 18 month process. And then after that, hopefully C sample, which we consider to be commercialization. And in C sample, we'd be putting our cells into modules into packs into cars, and actually doing real world testing. Skipped a couple of slides here. So this is just shows a picture. This is our Shanghai facility, line 1. This was completed March 2022. On 2 shifts, we would be able to produce about 1,000 cells per month out of Shanghai. We're doing A samples currently, and things could have the potential to shift around a little bit, but line 4, which would be B samples for automotive, will be in Shanghai and should be up and running by the middle of next year, and possibly line 5 in Shanghai as well. That would be for an urban air mobility customer. South Korea, we have 2 lines where we are producing A samples for 2 automotive OEMs, and we indicated November was the first month we actually produced 1,000 cells. And the volume of cells is important. It just shows, hey, can the technology be scaled? But also we're taking these cells and we're doing a lot of testing with them. We have bunkers in Shanghai and in South Korea where we take these cells right to the limit. We do all kinds of testing, different charging protocols, different temperatures, and we take the cells to their limit till they fail, and then we find out why they failed. Failure is not a bad thing, it's a good thing. We find out why they failed, and once we figure out why they failed, we can fix that. So many other battery companies are just operating and making cells in a little lab. We're producing them at a pilot scale, and we're doing all this testing, which is going to be critical for every company to eventually have to get to this spot. So we have the AI piece of SES. It was always SES AI. We didn't just change the name because AI got real big in the last 6 months or so. AI has always been an important component, being able to gather data on the batteries, understand why they fail, and we've developed algorithms to basically be able to predict a failure before it happens, which is really critical because obviously you don't want batteries blowing up in cars. You don't want to have issues like some car companies have had with massive recalls. So you want to be able to predict a failure before it can happen, and that way you can deal with it, whether you tell a driver to bring the vehicle into a dealer or you shut off some particular cells or a particular module in a vehicle, however it will work. But having this data, being able to do this is critical. So here's just targeted milestones, and we've already announced the big milestone for this year was to transition to B samples. We've basically announced that's happened. We've signed the B sample agreement with one of our customers. Here's our financial guidance for the year. We should probably end the year roughly around $300 million in cash. And with that, happy to take questions.
Eric, one of the things that seems interesting is the design for manufacturability, right? Because you look at a lot of battery technologies, they're great in the lab and they can do some pretty incredible things. But how has SES addressed making something that can actually be done at commercial scale and at a reasonable price? Because eventually that's for large scale adoption, those are the keys. Right?
Yeah, that's why it's a great question. So obviously making something in a lab and you can put out all kinds of data that show high energy density and long cycle life or whatever is great, but is it practical? And our approach is much more practical than some others in the sense that what we're doing is really just a small derivative of lithium ion today. Most of the people that are working in our organization have come from the lithium ion industry. Most of the equipment we use today is from lithium ion vendors. So the manufacturing process is almost identical other than the formation of the anode, which I talked about. We take extruded ingot, form lithium metal foil, we laminate that onto a copper foil, and then that becomes the anode, and we're replacing graphite. So at scale, we believe this will be very cost competitive with lithium ion, which it has to be. And that's for any battery company. If it's going to cost multiples of what lithium ion is going to be, then the car companies for sure are not going to use it.
Talked a little bit about the safety or the improved safety metrics. Can you compare how much safer these batteries are to their standard lithium ion? Because I know that's becoming a bigger concern with a lot of people. I mean, particularly with the smaller side, like e-bikes and the scooters, those battery fires being an issue. Can you talk a little bit more about how your battery is different from there and that advantage?
No, well, I mean, batteries have to be safe, right? They can't blow up. There's hazard levels that we have to be at. That was part of the process of actually getting to B sample, was proving that we can get down to the hazard level we needed to be at with one of our customers, and then going to the next level. Having the algorithms, monitoring the data, being able to predict something before it'll happen. So, for example, on the smaller cells, the cells that we make in our labs up in Boston, just outside of Boston, there's between 4 and 9 amp hour cells. We've been making those cells for many years, so we've had a lot of data. So we have like 99% capability to predict a failure in those cells before they happen. The big cells, which we're making in Asia, we just started producing in 2022. So we had no data. We just started making them. The algorithm at one point a while back was at like 60% capability, and now we're much higher than 60. I don't know the precise number, but just the fact that we've been able to produce more cells, we're collecting more data, gives us that ability to be able to know the health of those cells, and to see a problem before it's going to happen. And going forward on the new lines, the new B sample lines that we're going to be building, quality checkpoints. So we're going to have more data about every cell after it comes off the line. So if there's, call it 300 checkpoints on our A sample lines, we're going to have something closer to like 1,300 checkpoints on the B sample line. So we're going to know, obviously significantly more about every cell, how it was put together, and where it falls within tolerances, and that's going to, only improve the accuracy of the algorithms and knowing the health of the cell. Kathy?
Oh, I don't need a microphone. I have a very good enough.
Yeah, no, so the questions on raw materials, and then being able, where do the materials come from, and then obviously for the future, if you're going to build cells here for the car companies, if they want to get the whole $7,500 rebate, they're going to have a more supply chain that doesn't involve certain countries. So that's obviously still on the come, right? So a lot of those supply chains are going to come together. Right now, we're in pilot scale. We're mostly manufacturing big cells in Asia. So like where the materials are coming from isn't an issue. But if we were to commercialize, we would have to develop alternative sources. So which is going to happen anyway, right? So for the cathode, we're agnostic. And I would imagine that the way it would probably work, given that our customers are much larger than we are, they would be able to purchase the materials for us. So for the cathode, for example, they're going to be buying cathodes right, for their lithium ion cells. It's the same cathode that goes in our cell. So whether it's high nickel or lithium iron phosphate or whatever it is, they're going to have to do that anyway. We could help develop a supply chain locally for the things that are critical to us, like the salt that goes into our solvent and salt liquid electrolyte, and obviously the lithium metal foil. So those are things that we're working on. You know, it's too soon to be able to give you a very specific answer, but those are things that CEO is thinking about every day.
Eric, we have online attendee asking two questions. One is if you can speak to the charging characteristics and if you can compare your technology with the current lithium ion chemistry.
Sure.
And we have, I think, maybe a minute and a half left.
Okay, so charging, as far as charging goes, we've said we have the ability to fast charge. We've given out that information. So fast charging is not a problem. And if they want, there's information on our website with regard to that. The difference in our chemistry, we are very similar to that of lithium ion. You know, so what's different is we're taking the graphite out, we're substituting graphite for that lithium metal foil, which I explained before. And the electrolyte we make it's similar to the way an electrolyte works in a lithium ion battery. It's just the electrolyte is proprietary to us and allows lithium metal to work. As far as the cathode goes, I've said we're agnostic. We use the same cathode, whether it's a high nickel cathode or an LFP cathode, as what is found in a lithium ion battery today. So there's no substantial differences in terms of the chemistry.
Eric, thank you very much. If there are no other questions,
Great.
thank you.
Thank you.
Welcome back, everyone. The next presentation will be from Raymond Wang, CEO and President of Greenland Technologies, that trades on the NASDAQ under GTEC. So welcome.
Very much. Thank you very much, everyone. It's an honor to be here. Wanted to thank Water Tower for inviting me to this conference, and for everyone in person and on the call for taking your time to learn a little bit more about Greenland Technologies. So, in a summary, Greenland Technologies, we are a public company on the NASDAQ. We trade under company symbol GTEC, and our business is comprised of two core business units. We have our Zhongcai machinery business, which is what we started the company with back in 2006, and we are the leading manufacturer of drivetrains and transmissions for forklifts and other material handling vehicles. Then our newest business unit is Heavy Corp, which is based out of Delaware and headquartered in New Jersey. And the mission of Heavy is to manufacture all electric sustainable construction equipment to the United States market. And it is the first player to do so, so it is a pioneer in this space. And combined together, GTech will produce about $100 million in revenue, about $20 million in profit per year. At this stage, primarily through our core transmission business, and it's been rocking and rolling doing that since 2006 as a market leader in our space. From a quick stock standpoint, we actually have right around 13 million shares outstanding, about 3 million on the public float. And with our current share price right about at 2.5 to 3, it puts our market cap at about $30 million. The one thing I just want to throw out there is the fact that at this stage, we're sitting on a little over $20 million in cash. So we are trading at cash value. And in my opinion, to say that we are undervalued at this stage is an understatement. But let's talk a little bit about how we got here. So as I mentioned, Greenland Technologies, we started in 2006 with our Zhongcai machinery business unit in a humble facility overseas in China. And our mission was to produce the highest quality components that we could. We wanted to be a leading and premier player in the material handling manufacturing industry. So we focused exactly on that mission, and this is a key principle that is part of the Greenland culture, which is focus. And after a few years of sustainable growth, of expansion of our service, we established our brand, we penetrated the market, and then we became the premier manufacturer of high precision gears that's used in drivetrains and transmissions. Then, right around 2010 to 2011 timeframe, we took our expertise and then continued to move a little further up the chain to then produce our own drivetrain and transmission units. And we continued in that business until we mastered it, captured market-leading status in right around 2016, expanded our manufacturing capabilities to suit that demand, and then we continued to move further up the chain to produce drivetrains for not just forklifts, but then other material handling products such as large external logging and forestry machinery, light commercial EV products, and even military applications. Then we joined the company, we joined the NASDAQ in 2019 via SPAC. We did it before it became the flavor of the month. So I always like to say that we were the model on the street on what to do and what not to do in with SPACs. But that is how we joined the NASDAQ. Just like with anything in business, we adapt and we made the best of it. And right now we are trading at the levels that I mentioned a little earlier. This is also when I joined the company as CEO in 2019 and introduced my mission to continue to further expand the business capabilities of Greenland. At this stage, we're already market leader in the manufacture of components of transmissions and drivetrains. So I wanted to take the company to the next evolution, which is to become an OEM ourselves. And we're not another Me Too player. That's not how we've achieved success with Greenland over time. So we wanted to take our manufacturing and innovative principles to apply electrification in a field that no one else was playing in. And this is heavy duty construction equipment. I'll get into details a little bit about what I mean by that, but we introduced Heavy Corp as a wholly owned subsidiary, specifically with this focus to electrify this industry. And we launched our first product line in 2022. We have all electric products that range in size from 12,000 pounds to 40,000 pounds. So definitely not something you'd see in front of a Home Depot. This is true electric assets to make job sites across America much cleaner. And that takes us to where we are today. So I'm not going to dive too much into the product evolution. Wanted to explain a little bit about our core products. Don't worry, I'm not going to bore you with every single product we make. We do over 44 different series, each with between half a dozen to a dozen models. So if I were to do that, I'd take up more than all of the time I have and everyone would be asleep. So the only thing I want to call out is the drivetrain on the upper right, because it really showcases the innovation and offering we provide to our clients. So what that unit is an integrated drivetrain specifically catered towards lithium-powered forklifts. What we did is we took the three most difficult components for a lithium-powered forklift, the electric motor, the speed reduction gearbox, and the driving axle, and popped it into a single unit, a single package that an OEM looking to make their own lithium-powered forklifts can take that and pop that in. It cuts their development time by about 60%. Now, I bring that up because this product line, we're extremely proud that it truly pioneered and launched the adoption of lithium-powered forklifts on a global scale. This product powers the world's leader in lithium-powered forklifts today and is inside right now over 24 different brands around the world. This product line also, on our side, earns us a 30 to 35% margin. And in the component industry, that is unheard of. Most folks would be happy just getting to 9 or 10%. This is doing 30. And this showcases the capability on what we are able to provide to our clients and then to the company and our shareholders. The market leading status of our component business allows us to continue to grow as the global demand of forklifts continues to grow. Right now, depending on who you ask, it's going to be between 8 to 12% compound annual growth rate. And as a market leader in our space, as the industry continues to grow to try to meet the demands of e-commerce, Greenland is going to continue to grow with it as well. Right now, we'll sell about 180,000 units per year. That's produced and delivered, producing about $100 million in revenue. And with our focus on improved margins, that continues to grow, so our profits continue to grow with it. This is where the magic happens. We have about a 700,000 square foot facility overseas in China. It's outside of Shanghai by about 2 hours. Our subsidiary, Zhongcai Machinery, is labeled a high technology enterprise overseas in China. So even in the landscape of manufacturing overseas in China, we are labeled the cream of the crop of that. This affords us with a advantage on our tax rates across the board, and it allows us to borrow any money we need to support our operations, such as buying raw material to produce and fulfill on our contracts at extremely, extremely favorable rates. And this site has the capability right now, as is, to produce over 400,000 drivetrain units. As I mentioned, right now, we're actually producing about 200,000, about 170 to 200,000 to meet demand. So we already have the capability to continue to grow to meet the global demands of material handling around the world. This is what allows us to cater to all of the tier 1 brands in the material handling industry, from Linde, Hitachi, Toyota, BYD, just to name a few. Right now, we support over 100 different OEMs around the world, and we cater towards long-term established brands. We're not a onesie, twosie. We are the premier player on the block. We actually are the most expensive product on the block, but we are the largest because our statement that we are a market leader is not PR, it's not marketing. This is our stance. We're able to push the products that we can and enjoy the margins that we have because we have that status, we have the reputation to serve these tier 1 clients around the world, and they trust us because we are the only ones that have the manufacturing capability to make these highly complex products at scale with the quality that they can put their brands behind and the innovative talent to introduce new product lines for them to help them maintain their leadership status for their respective markets. And that's our component side of the business. But let me shift over to Heavy Corp. And unfortunately, this is a site that we are all too familiar with, especially here in New York City. Just walking over here and from Chambers Street to where we're located today in Vesey, I already walked by 4 construction sites, each operating heavy equipment, billowing massive plumes of smoke right around our schools, the universities, and our residential areas. Right now, this has been diesel for over a century. The only thing that came before diesel power was steam back in the 1900s. There is no available option today for any company looking to have a cleaner job site until Heavy came around. So from a demand standpoint, from a timing standpoint, right now, on a global scale, everyone is comfortable and believes in the benefits of reducing carbon emissions produced by passenger cars. And each car, according to the EPA, will produce about 5 tons of CO2 per year. Now, most recently, there's a big focus on electrifying transit buses, school buses, MTA buses, whatever have you. There's about between 150 to 200,000 buses operating in the United States at any given moment, each producing about 35 tons of CO2 per year. Major producer. And the next stage, the next application to really move the needle on reducing carbon emissions and NOx as well, which is going to be a focus in the next few years, is going to be heavy construction equipment. A small size compact loader, which is that Caterpillar product you see right there. A compact one right around 10 to 12,000 pounds will utilize about 4 gallons of diesel per hour of operation. And those are advertised brand new off the lot rates. That, though, taking that value, will produce over 90 tons of CO2 per year. 90 tons. You need 26 acres of forestry to offset that carbon for one compact vehicle. Majority of heavy equipment, though, used aren't compact. They're going to be full-size units over 40,000 pounds, burning upwards of 8 to 10 gallons of diesel per hour. And unlike transit buses, at any given moment, there's about 1.2 to 1.5 million pieces of heavy equipment being operated in the United States alone. So the more of these heavy equipment products that we can switch over to cleaner technologies, the more we can move the needle to offset emissions and have a cleaner community for ourselves, our neighbors, and our families. From an opportunity standpoint, I always like to focus on the forklift industry because with our own side business, that's kind of our bread and butter. But over time, for over $50 billion a year industry, growing at a very healthy compound annual growth rate, right now it's already gone through the transition and evolution from fossil fuel and propane over to electric. Overseas in markets like in China, in Europe, right now about 9 out of 10 forklifts sold are already electric. And of that amount, over 85% are lithium powered today. Now, here in the US, we are a little bit behind on it, but we've already seen a dramatic swing towards it. Right now in the United States, about 1 out of 2 forklifts sold are electric. And at the moment, about 70% of those are lead acid, but lithium is going to convert over very rapidly. The reason being is our market leader with electric forklifts is maintaining that technology as long as they can before they have to switch over. But they have the capability to do so at any given notice, so it's just a matter of time. But we switch over to just a subset of the heavy equipment industry, front loaders and excavators, which just happens to align with our initial product line launch. But I digress. Those two combined are about a $70 billion a year industry. And as I mentioned, there is no option available outside of diesel. So from an electric market share standpoint, I'd love to put 0, but it's practically no. If you were to try to buy any type of non-diesel product in that space, you're stuck. You have no options today. But the demand is there for it, and we will start seeing the construction heavy equipment industry begin to follow the forklift and other material handling industries as well for cleaner technologies for adoption. And the reason being is because from a ESG and sustainability standpoint, this is becoming ever more adopted from both a country standpoint and a company standpoint. These slides are a little outdated, but right now over 1,000 public companies on a public exchange have embraced decarbonization targets as part of their company values and ethos. From a country standpoint, right now, over 100 different companies have set net zero emission targets. And right now, I think it's about 60, a little under 60, have actually put that into law. Whereas from a technology and capability standpoint, the reason why we continue to see more adoption and more applications for electrification is the cost to electrify these product lines continues to fall. We started in 2010 with passenger cars. Most recently, we've seen transit buses and applications switch over to electric. And now we're at the stage where electric heavy equipment are sustainable for adoption for businesses. And this follows exactly what the wonderful company SES that followed me prior was showcasing as well. The technology continues to advance and the cost and economics for it continues to become more and more attractive. And this is what we are entering the market with. So at 2022, Heavy launched its first line of all-electric heavy equipment. We have 3 units, these 2 front loaders and 1 excavator, that ranging size from 12,000 pounds all the way up to 40,000 pounds. That GEL 5000, that's my son's favorite because it is 40,000 pounds, about 14 feet tall, and that's a 4 cubic yard bucket. So he always jokes that that's going to become his bedrooms because it's bigger. These are machines designed to do work. Each machine can operate for over 9 hours on a single charge because these are business assets. If it can't do 9 hours, then they're really just a toy. To do that, they're powered by a LFP battery that we source from CATL right now, from CATL, the world's leader in battery manufacturing, the same batteries in Tesla, Ford, GM. That's what allows us to do so. That GEL 5000 uses a battery that's nearly 2.5 tons in size, but you need that power to be able to give it that 9 hours of life. And with these product lines, they're extremely cost effective, which I'll dive into in just a little bit later, but their maintenance is significantly lower. We know from the passenger car industry, it's well adopted that electric versions are going to have 40% less maintenance compared to their gasoline equivalents. We actually see our equipment having about a 60 to 80% reduction in maintenance because thankfully no one's taking our loaders 90 on the highway, so we don't have to deal with that wear and tear for our electrical systems. And this is one of the challenges for our product line in this traditional model of selling and distributing product through a dealership approach. Because especially in our industry where right to repair is such a critical issue, and that's because it defends one of the largest revenue streams for a standard dealer, which is the maintenance and repair capabilities. Our products would never see the light of day on a dealership lot because of that. They're not going to sell electric and take a 60 to 80% pay cut when they can continue to sell diesel. I bring this up because we are following a direct sales model. And to do so, to properly service it, our business focus is entirely right now on the Mid-Atlantic region of the United States. The reason being is, as I mentioned, from a culture standpoint, to succeed, we need to focus our efforts. So instead of trying to capture the world, instead of trying to capture the United States all at once, right now, we are focusing on penetrating and establishing our brand in the Mid-Atlantic region first. We define that from southern Connecticut all the way up to the Virginia, Washington, D.C. area. Once we penetrate this market, capture market share right about 2 to 3%, then we'll push over to the South Atlantic, then we'll leapfrog over to the West Coast, and then we'll come back to Central on 2 fronts. And this is how we're going to succeed. This also allows us to disrupt the industry because unlike other product lines or standard purchasing process today, to have the pricing for a piece of equipment is very, very difficult to obtain. You have to jump over a lot of hurdles, make a lot of phone calls, even just to get a price quote. But we can be upfront about it. There's no gimmicks, there's no hidden fees, nothing. We actually put our price right there for any interested prospect looking for our equipment. I will dive into the pricing in a little bit, but I will say right now, just to set expectations, the pricing that you see here are comparable to their equivalent diesel. We do not charge a premium for our equipment. We won't get adoption without it. So there's no premium on our equipment. Anyone looking to consider cleaner options for their job sites and for their operations won't have to worry as much about the bottom line. Now, where are our products best suited for? So first thing, let's talk about the benefits itself. Because our products are all electric, they have a very small carbon footprint. There's no operating emissions. So let's say if you're doing work in a salt silo, inside a greenhouse to clean up produce, or inside a livestock barn to clean the barns, load feed into the hoppers, or inside of a recycling center indoors. You don't have to worry about putting big respiratory units to pump out the emissions and not harm your employees and the neighboring area. There's no emissions at all. Plus, also, you don't have to worry about the emissions affecting the quality of your assets or products in the case of agriculture. Our products are bone quiet. One of our fun tasks that we do when we give demos for our equipment is we walk around, we talk about the features, and then once we've done a lap around the machinery, I jump inside, move it, and it shocks everyone. Because if you've been around diesel heavy equipment, you know you can't be next to it and even have a conversation, much less not know in arm's reach that it was on. So this makes it wonderful for applications from a safety standpoint. They're simple to use. If you're that rural farmer operating pieces of equipment, you no longer have to worry about buying, transporting, and storing fuel on your farm. You have your charger, you plug it in, you use it during the day, plug it in overnight, and it's ready to go the next day. Couldn't be any simpler than that. And they're very simple to maintain. As I mentioned, no more spark plugs, no more filters, belts, none of that. And this leads to a significant savings from a fuel standpoint, which I'll get into in a little bit. But as I mentioned, a piece of heavy equipment will burn between, let's say, 4 to 8 gallons of diesel right off the lot. Diesel right now is right around $5, $6, $6 here in New York City, $5 in New Jersey. My mother lives in California. You don't even want to hear those rates. Whereas from an electricity standpoint in our area, it's about 7 to 11 cents a kilowatt hour. So it takes only about $4 to $6 per hour to operate our equipment. Major savings there for a business. And this makes it perfect for many types of yard applications. These are applications where this machinery always has access to electricity, is not leaving that site, like waste management, property management, public works yards, manufacturing, agriculture, and the list goes on. A little example of our equipment working some salt, which actually is a wonderful example because right now from an EPA standpoint, we're finding that salt in our regions is a source of fossil fuels getting to our waterways. How? Because we store salt in silos. We utilize heavy emission diesel equipment to maintain those salt silos, load them up. This whole time it's trudging around, producing emissions, having fossil fuel spillage. The salt just sucks up. We put it into our plows, they dump it on our roads. And when the salt melts, it just melts it into our waterways. And then you see oil slicks after every snowstorm. But with our equipment, that entirely eliminates that. And cleaner waterways, this is better for all of us. Now, from a cost saving standpoint, this is the biggest way on how we get interest first, because these are business assets. We're selling to organizations. These aren't emotional, leisurely sales like a Tesla Roadster for certain lucky individuals. So to get people interested to consider new technologies, we had to make it make sense on paper. So as I mentioned, there's no sticker shock, there's no premium for our equipment. Factor in the maintenance savings of between 60 to 80%. This table uses 40% to be conservative. Then from a fuel standpoint, that's the biggest savings. Combine that all together for our 40,000 pound loader, a business is looking to save $70,000 year one by adopting our equipment. And then from there, we can have the conversation about the environmental benefits and the operational benefits to integrate our product. And right now, there's over a million pieces of heavy equipment. It's a $200 billion a year industry. And if we are successful in converting these diesel products over to electric applications, this shows the growth opportunity for what we're trying to do here. Now, for the sake of time, I'm actually just going to jump to a quick summary about Greenland itself. Because just to wrap things up, from Greenland itself, we have our core component business that's producing about $100 million in revenue, about $20 million in profit, and consistently growing. It's been profitable since 2007, the first year practically that we started. This provides significant value to our shareholders. Couple that with the growth potential of heavy, where we have first mover advantage on a $200 billion a year industry. Should we succeed in penetrating this market and even capturing just 2% of that, which that's the level where we think we can maintain first mover advantage before we see any true competition for the next 7 years, then we've provided significant value to both our company, our clients, and our shareholders. And in a nutshell, that's Greenland Technologies.
Raymond, thank you very much. I didn't mean to cut you off 2 minutes ago. Great presentation. I wanted to go to the room, see if there are any questions from anyone. All right, wonderful. We have just time for about a minute, one or two.
Just quick. Can you just talk about your sales traction on the heavy side?
Yep. Absolutely. So we've gotten significant interest for our product line, being it's the only available option today in the United States. Our focus right now in establishing our brand and penetrating the market is achieving fleet sales, pilots, and demos with national brand companies. So this way, one of the questions we often get asked is, who's utilizing your equipment? I can say, hey, this national brand rental company is using 20 of them. They're loving it. That has more value than if I say, Joe's Landscaping down the street utilizing one. But the way that we actually sell our equipment is through live demos. We stand by our product, and instead of us talking about it, we give them the keys, we bring it to their lot and say, do work, have fun, let us know the feedback. And we've gotten some tremendous, wonderful feedback and interest in our product line.
Quick question on your first mover advantage and your ability to capture market share. There are established players in the construction industry, construction equipment particularly. Do you see them getting into this field already? Are they about to? Can you talk about the competitive landscape, let's say 3 years from now? And what do you see, not so much from the smaller companies like yourself who are trying to establish market share, but from current leaders who are maybe looking to switch to a battery-powered construction equipment or mining equipment?
So with the market leaders today, the big players, if they had their wish, it would never switch over to electric. The reason being is because it completely disrupts their business model. We see that in the passenger car industry today. Toyota, Volkswagen, BMW, they all had electric versions of their cars back in the 90s. They'd parade them around the car shows, show that they're sustainable, but you couldn't buy them. It wasn't until a player Tesla came in, converted 2 to 3% of the industry over to electric to force them to come in. And they're still trying to figure out how to sell their equipment. GM is subsidizing a lot of their dealers to try to push it, but it's still practically hidden on their lots. If you're GM, then you bypass the dealers, sell online, but what kind of message does that send to your dealership force? And it's a challenge, it's a struggle, it's a Pandora's box that they would never open if they can avoid it. If we look at Caterpillar, their last earnings, they have a $24 billion a year backlog on their diesel equipment, and that's an improvement. It went up to a height of $96 billion during COVID when they had significant supply constraints. There's no interest for them to switch that over to electric, cannibalize their business, and then earn 60 to 80% less in just maintenance parts alone, which is the major revenue stream for their dealership. So if they had their way, never go over. Very quickly, for smaller players like us, the standard flow is they're going to start with smaller product lines. You're going to see skid steers, mini excavators, products that are about 1 to 2 tons in size over the next 1 to 3 years. You're already seeing them in CES. Bobcat actually did a launch that failed, but that's another story. You're going to see that. They're going to establish the market share there because it's easier to prototype. Then they're going to get their manufacturing in order from 3 to 5 years. And it's going to take to that level before they can expand into ours. So that's the 7-year runway. Because we already have the manufacturing capabilities, that allows us to jump right into it.
Raymond, thank you very much. Unfortunately, we are at time. If you have any other questions, please approach Raymond.
Thank you.
Right, hello, everyone. Thank you. Our next presentation will be from John Belizaire, the Chief Executive Officer of Soluna Holdings, which trades on the NASDAQ under the symbol SLNH. Welcome, John.
Thank you. Thanks for having me, Graham, and thanks OTC for hosting this event. Before we get started, I am going to walk you through the usual disclaimers. Since I don't have my glasses, I can't read them from here, but you should assume that they're saying that we're going to include some forward-looking statements here, and we'd like you to treat them appropriately. There are some things we are focused on doing that are in our plan, and the full sort of legal disclaimer comes next. So before I start my full presentation, I want to touch on something that Charlie Munger has said, or known to have said when he was alive. And that is, if you want to be successful, you have to take a simple idea and take it seriously. And that's exactly what we're doing at Soluna. We are taking essentially a simple idea, and that is that renewable energy should be the primary source of energy used around the globe. And making renewable energy a superpower, there are many ways to do it, and we think computing is the perfect catalyst for making that happen. And we work essentially maniacally about combining those two things to make that true. So let's go through what we do as a company. Our simple idea, our simple business is we take wasted renewable energy and we convert it into low-cost, scalable compute resources, primarily focused on high-density compute, high batchable compute operations that need lots of computing power and lots of high-density power and energy. And the two areas that we focus on as a company, one is Bitcoin mining, which is a perfect computing application for rural areas that have renewable energy, and in the future, high-performance computing. And we'll talk a bit about that going forward. Why are we focusing on this, though? Why are we going after wasted energy, and how big is that problem? Well, renewable energy is on the rise. Wind, solar, hydro, anywhere you think about it or look into it, you're going to see increasing investment on a global basis. In 2022 alone, you saw a rise from the hundreds of billions of dollars being invested in renewable energy infrastructure to reaching the trillions of dollars of levels of infrastructure. But there's a little known secret in the green infrastructure or renewable energy space, and that is that 30 to 40%, I repeat for the folks online, 30 to 40% of the energy that is produced by these power plants never actually makes it to the grid. The reason for that is because the grid was designed to be a synchronous system that synchronizes demand for power and the supply and production of that energy. And over time, as you replace these synchronized power plants, primarily coal, gas, things that can be fired by the facility, the infrastructure companies themselves, you start to see a shift whereby the control of the production of that power is no longer in the hands of the regulators or the power infrastructure companies. And so Mother Nature decides how much power is produced. And so you'll start to have mismatches. In California, they have incredible irradiation. So you have sun shining brightly in the day. And prior to COVID, well, no one was home taking advantage of that because they were all at work. And so you don't have a lot of demand, even though you're producing a tremendous amount of energy. And it produces a problem called the duck curve. Wind is the same. Wind may be blowing really high at night in Oklahoma, and everyone might be asleep at the time. So you have these mismatches. And so power plants, which are businesses themselves, need to monetize all of their energy. They need to sell every megawatt. And so the challenge for them is what to do about this stranded power, also known as curtailed energy. We estimate that somewhere around $7 billion a year of lost revenue happens in the industry because of this problem. And if you were to solve this problem, essentially you would increase the investment of renewable energy over time because they have this issue resolved. And by the way, $7 billion a year is just the revenue they make from selling the power, not from all the other tax credits and bonuses that they get from building out the infrastructure. So how do we solve this problem? We go to a power plant. I like to say sometimes I drive my little truck with the Soluna logo on it to a big power plant company and say, hey, those wind farms up there or those wind turbines don't seem to be spinning. You must have curtailment. We can solve that for you. And they're expecting me to do something about increasing the power line capacity or building a battery. And I say, no, actually what I'm going to do is I'm going to build a data center over here that's going to consume all of the wasted energy when it's available. And so every time we add more of that load, more of that power consumption or unused power is being produced. So in this example here, I'm showing if you have a 150 megawatt wind farm, for example, that has went live in 2016. And as you can see from the far left there, over time, the amount of energy that doesn't make it to the grid, the red bars, increases up to 40%. And it's still increasing actually in that particular location. What we do is we bring a 50 megawatt data center that will consume a good portion of that. You can see we've dropped it down by 50%. We double the size of the data center. You start to see that drop, and we virtually eliminate it over time. There are, optimizations around the size of the facility that we make, and that's part of the technology and process that we perform. Once we do that, we have now monetized that energy, and we have also unlocked the production tax credits and all the other goodies that they get by building out this infrastructure. Because we are putting this facility right next to the wind farm or the solar plant, we now have access to an abundant series of sources of energy from three key places. One is the curtailed energy, the energy that we're buying that would otherwise not have generated revenue. We buy that at a fixed cost. The second source is what we call subtractive energy. Because we're there, the power that would have gone to the grid, we consume it. We essentially pay the power plant the same costs that they or revenue that they would make at that location. So they're indifferent. And then the third source is grid energy. So when the wind farm is blowing, but it's smaller than us as a data center, we would need more energy to hit our uptime requirements. And so we source the extra energy from the grid. But because the power plant is located in these remote areas, most of our power will be green. In fact, we design our facilities such that over 70 to 80% of our power is coming from the power plant, and more than that is green in terms of its mixture for us. So our data centers are essentially a super productive battery. We've designed them to efficiently convert the electrons that come from the power plant into high performance computing in powerful space. And we've designed advanced cooling such that we can put more of the energy into computing versus cooling the facility. So we have a proprietary design there. And then the other thing we do is in the picture I'm showing you, that's one building, but most of our farms, that one building is approximately 1.2 megawatts, give or take. So in a 50 megawatt facility, you'll see 40 of those buildings combined into a sort of unique design, helix design, that essentially allows us to build a large facility that is highly flexible. So if I go back to that power example, we optimize the source of our energy from all of those three places to bring our weighted average cost of power to $30 per megawatt or less. That raw input cost, if you will, becomes the driver for the computing business that we have in those buildings. To make all of that happen, we have a proprietary set of software we call Maestro OS. It's a suite of software technologies that allows us to manage the buildings and operate them, read the power prices, price of Bitcoin in the case when we're doing Bitcoin mining, and essentially optimize the size of the site, its computing capacity at any given time in 5-minute intervals. So we can scale and shrink the site very quickly to optimize its capability. And we've been able to prove this out in a number of our projects, and it works really, really well. Now, how do we turn this into cash? How do we make money as a company? And why is it interesting as an investor to look at this company? What we're essentially doing, as a reminder, is we're efficiently converting wasted energy and green electrons into revenue, into profits. And we do that in 3 ways. The first is through joint ventures. We will build facilities, and inside those facilities, we'll buy computing equipment that mines Bitcoin. The nice thing about a Bitcoin mining facility is that the production of revenue and returns is very formulaic. You don't have to build a sales force to go sell services and so forth to companies to do this. You can monetize that very quickly, and allows us to build out these facilities that can monetize the investment in 2 years or less. The same is true for hosting folks who do Bitcoin mining. So we build out the infrastructure, the power, and Bitcoin miners can come in and basically plug in their machines, and we charge them on a volumetric basis to do that. And that allows us to diversify Bitcoin across those two elements. Now, remember earlier I talked about the fact that our data centers can shrink, get bigger or smaller depending on how much power is available. That flexibility that we perform is actually a very useful behavior for the grid. When the grid needs more power, we can scale down our facility to only use power from the power plant, such that power on the grid can go back to the needs that the grid has. Well, the grid is actually open to paying for that, because it becomes an asset or a resource for the grid to help it do the things that it needs to do as more of these intermittent resources come online. That's known as ancillary services. We get paid to do that as well by registering our facility as a resource for the grid. And in fact, we can earn upwards of $10 per megawatt hour. So I talked about our price earlier. We structure everything to get $30 per megawatt hour or less. So if we earn another $10 for our behavior, suddenly our price drops down to $20 or less, making us one of the lowest price providers, if you will, of Bitcoin and Bitcoin mining infrastructure. And that means for the behavioral aspects of Bitcoin, when it's volatile and so forth, our facility will be the best home for a Bitcoin miner or JV Bitcoin operation, because the lowest cost power and the most powerful compute is the name of the game for success there. Now, the fourth area where we make money is something that we're going to be doing in the future. What I've done is I've converted a wasted asset into a productive computing resource. Well, computing is not limited to just Bitcoin. I can do other types of things as long as that computing is what we call batchable, something that you can put to sleep, right? So if there's no power or portions of the building has to go dark, you can do that. And so there are sectors within high performance computing that are becoming more and more tuned to the concept of computing like this. So I've talked about the fact that there's a problem in the renewable energy space. Now, let's talk about data centers and computing. Over the next several years, we are going to see the largest increase in computing infrastructure in a long time. Probably in the last few decades, we've seen a massive growth of the internet and its use for social media and all sorts of applications. And in the last year, thanks to a little company called OpenAI that has had some interesting drama lately, everyone is excited about AI. And the reason is, I'll tell you a little story. When I started my career as a computer scientist, I was at Cornell. I was in a computing lab with all my other geek friends, and we were fascinated by this new technology that was on one of the servers there. It was a web browser called Mosaic that essentially its purpose was to help you to navigate this interesting thing called the internet that's been around for a while. And it could be a place for you to put information so people can find your information. Mosaic wasn't clear what it was good for, but it certainly sparked an incredible imagination for just about every person that was in the technology space. And for the next 2 decades, that imagination had turned into trillions of dollars of growth, trillions of dollars of losses, and hundreds of billions of dollars of growth beyond that. And if you look at that growth, that momentum, it was driven by the fact that you had the internet, which was relegated to universities and the military, convert into something that became basically ubiquitous. Anybody can get involved in that. Well, ChatGPT is essentially the same thing. When I logged into that system, I had the same experience as I did before 25 years ago, that this could unleash an incredible growth in the amount of computing that will take place. The question we have to ask is, because we are now going to be doing computing at a level that we've never seen before, it can have negative consequences on the sustainability and power and so forth. And I'm going to talk a little bit more about that. But the opportunity is, if you combine these two problems, where computing is growing at a high rate and it needs sustainable power, what can you do to benefit from that? And it just so happens that the Soluna business model is a perfect sweet spot for integrating those two things. So if computing is generative AI, scientific computing, natural language processing, those things, and we're going to prove, can be done in these remote areas integrated with renewables. Now, why is AI growing so much? It's the story I just told. ChatGPT went to 5 million users, the fastest growing growth in that in 5 days. Within a few months, it was already 100 million users on the platform and is growing exponentially. The compute is growing exponentially. The applications are growing exponentially. The models are growing exponentially. There's a company called Hugging Face that essentially is a marketplace for models that you can use to train on your environment to solve problems for your business. It went from having tens of models to, last I went on the system, it has nearly 400,000 models of all different types. If you want to take the legal contracts in your business and try to fine tune to figure out how should I consolidate those so my contracts are a little simpler, where you can give it to these large language model platforms, they can learn on your contracts and propose a system to do that. To do that, you need computing, and everyone is going to want to do that. And that's why the growth potential for the market is huge. It will be all the big numbers that you can imagine in the next 10 years. I actually think it will be bigger than that. And I think it will grow faster than the internet has grown in the past. Now, here's the interesting thing. I said you need computing to do that. Well, the traditional data centers were designed for applications that are very real time and tuned. They're tuned for gaming, for social media. The way the design of the facility is for those types of applications. And so as a result, you have all the data centers built near large metro areas where there's power available and internet access available for those applications. But when you start to look at scientific applications and AI specific applications, the needs are very different. They actually need to be very close together, these chips. They need to be internetworked so every single chip can talk to the other. ChatGPT was trained approximately on 10,000 GPUs. GPT-4 is being trained on 20,000 chips. So imagine a huge building with all these chips in it and so forth and being integrated. The other interesting thing is you don't have to keep those chips modeling the entire time. You can pause them if suddenly there's a change, there's a loss in internet. It can actually put the modeling process to sleep, and then you can wake it up again. The other interesting thing is that you don't need all of the redundancy and cooling infrastructure for these types of applications that typical data centers have. So most of the big data center companies are finding themselves in a weird state right now where the requirements for the new compute that are coming in don't match the buildings that they currently own. And that's where the interesting opportunity is. The power density is different. A typical rack in a data center is 12 kilowatts. You know what AI is? 50 to 100 kilowatts. So the power density is really high. If you look at the water usage, there's a massive amount of water usage to cool computing in these facilities. So that water usage will increase significantly. The third is most of that power density, because it's so high and the space required to contain the computing is so high in that power density, they have to build entire new buildings. So you're seeing hyperscale data centers actually build containers on the roof of the buildings, and they're begging the power companies to give them more power. And that's opened up the opportunity for specialized data centers specifically designed for AI compute and integrated into large, abundant, sustainable power. And that's the opportunity that we have. Everything I've just described about the behavior and nature of that compute, we're already doing on the crypto side. Cryptocurrency mining, for example, is high density. You have thousands of chips being integrated in one location, and they use lots of power, and they need lots of advanced cooling. What we're going to do as a company is take our existing facilities, which are already pre-envisioned to support this capability, and enhance it with the requirements that are ideal for the AI revolution, if you will. So direct liquid cooling, the concept is you have a plate that sits on the chips themselves, and a special liquid flows through it that cools the chips down. So you don't need to use water from the local area. And look, where these locations are, this facility that you're seeing right now is in the desert. There's no water there. So you need air cooling, you need specialized liquid to cool the plates down. We're going to be using green power to do that. And our facilities will be plug and play, so you can integrate them very easily. And it's going to be scalable. And our positioning will be that we will build these sites for the most advanced AI training facilities. This new design is what we're calling Helix. We announced that earlier this year. And this site here, just past those buildings, is where we'll be building the second phase of our Dorothy project. And in there, we'll include this new Helix design. Now, when I say we're going to combine this with power, we're going to combine our software, this new data center design, and the large pipeline of power projects that we had. Yesterday, I sat with probably one of the largest infrastructure players in the country. They have $17 billion of assets under management. They had us walk through the production and returns and the power use that we have been providing and incremental revenues on the Dorothy site. And it was clear to them that they should open up their portfolio across all their assets to us to determine which projects we want to do to add to that pipeline. So this 2 gigawatts is an example of what's been happening with our brand. We have become synonymous with curtailment mitigation or curtailment solutions, if you will. People understand our project structure, and they understand how it can benefit the project. And it doesn't constrain these power plant projects at all. It actually preserves their optionality and allows them to continue to grow, and it recoups a lot of money for them. So how does this translate into the financials of the business, and what has the company been doing in the past year? So I ascended to the CEO role, sat at the helm in May of this year. And I came on when the company was just coming through the crypto winter, if you will. Just about every company was going through some tumultuous process. And I've been essentially having to focus my team on working our way through that winter, if you will, and coming out of it. And we are essentially turning the corner. So we are taking our business from approximately 75 megawatts under management. So we have 50 megawatts in Texas, 25 in Kentucky, and we have over 290 megawatts already planned that we can see in our pipeline of mature projects to build out. We have consumed over 11,000 megawatt hours of wind power from the power plant that I showed you, and we run the most efficient machine. So if you're familiar with the Bitcoin environment, you need efficient machines, low cost power, scale to be successful, and that's our goal. See that 1.01 number there? That's a measure of how efficient our data centers are. So if you put 1 joule of energy into the building, we use almost all of it, 90% of it, if you will. So that 0.01 is what we're using for cooling the facility. And if you look at our projects, we have the second phase of Dorothy that we're building out, as I've alluded to before. And we have another 166 megawatts in a project called Katy that we're going to be building out. And then we have more than 2 gigawatts from there that we can draw from and mature. As we mature projects, that draws in capital that allows us to build out these facilities. These facilities return capital every 2 years. The returns and excess returns flow up to the parent. Think of the Soluna company as a GP, if you will, and that continues to scale over time as we add more assets. So we've been focusing on energizing Dorothy, building our cash flow and managing our costs, expanding our flagship Dorothy 2, and then growing the pipeline over the last few months. And if you look at our quarterly financials over the last several quarters, you basically start to see a measured improvement as we shift the business from primarily doing proprietary crypto mining to becoming more of an infrastructure company where we offer a space to do that, or we move into some of these other sectors. You start to see growth over time. And so year to date, we have generated over $10 million in revenue. We'll continue to grow that over the next few quarters. If you look at the mixture between the different revenues, so I showed you those 3 ways we make money. Most of this year was in the 2 of the ways, Bitcoin mining and Bitcoin hosting. And later this year and into next year, you'll start to see revenues from the 3rd way, that ancillary services piece, which will begin to add to our growth. Now, 2024, as I've been alluding to, is really a focus for us for growth, expanding our facility on the AI piece. This is a quick layout of where our new AI data center will be in Dorothy. And as we begin to crystallize all of the details and projections, we'll start to put that out to our shareholders so they understand what this could do for the company going forward. With that, I'd love to take some questions. Look, I still had 15 seconds, not bad.
Thanks, Sean. Wanted to focus on, obviously you're moving to a different kind of compute from full 5.9 uptime to batchable. How are you pitching that savings for companies, and why aren't they seeing that immediate cost savings for different types of compute that you can offer?
So to play it back for the folks on the, are they hearing what his questions, or do I need to repeat it? Oh, they are? Okay, great. Okay, so cool. The biggest thing about innovation is education. So most people believe for any kind of application that they're doing in a hyperscale data center, they need 5 nines, 5 nines plus 1 uptime. And that's because of the types of real-time applications that they're doing. The reality of it is that the more batchable training portions, we're not talking about inference when you type into ChatGPT and say, write me a song. That's inference, where it's using the model to answer your questions. Training is a batch process. I can train for 3 months, see the results, test it, train for another 3 months. So it's a very batch-oriented process. And so most of the sense is that people need to have super redundant facilities to do that. And what we're doing is we're beginning to position that that's not true. Our strategy to do that is not to build a building and say, hey, look, come use this building. It doesn't have all the things you expect it to have, and it's going to be fine. The better approach is to build a building, put the computing in there, and say, use the computing for your training. When they see that they can train and have no measurable difference in terms of their experience for that training in those facilities, then they will start to unlock or remove the constraints of the training or education that they need, that 5 nines expertise. So our job as a innovator will be to begin to educate the space. And to do that, we have to prove it ourselves. And that has worked really well for us. We said Bitcoin mining can be something that drives renewables. And they says, prove it. And so we built a facility. Now we're proving it. And now we're just going to replicate that. So we would do the same thing there. That's why we're putting the Helix solution at Dorothy so that we can prove that example. More questions?
John, it's been an impressive turnaround coming out of what was a very cold winter for you guys. What should
Hold on there
invest-
again. No, just kidding.
But you guys are in a much better place than you were 12 months ago. What should investors be looking for as we move into 2024?
They should be looking for us to continue to grow the footprint of our assets. Our flywheel works like this. We source the green energy from the power plants, and you now know how we do that. We spent a lot of time marketing. Actually, now people just call us, so we get access to this huge pipeline. We build these facilities, and the way we build these facilities is we finance the projects at the project level primarily. As capital markets open, we'll be able to also use the equity markets to do financing and build that out. So you want to look for new investment partnerships and project partnerships that allow us to build out these facilities. Two, you should start to see more scale in terms of profit being generated, because as we add more facilities over a fixed cost basis, we're able to generate more EBITDA or profits, if you will, because it doesn't cost us that much more on a fixed cost basis to add more facilities. Each facility is self-contained in terms of P&L. And so the excess money that flows up supports a bigger and bigger footprint. Okay. So scale is really important for us. So you're going to see us focus on scale. And then the last thing is diversification. So we're going from primarily Bitcoin mining, we're expanding into ancillary services, and you'll start to see the effects of that ancillary services not only on revenue or indirectly on power cost, but you also start to see us diversify beyond the Bitcoin space. And that's going to be a big focus for us in 24.
John, we have a question from the online audience, I think kind of dovetails with your last answer.
Okay.
They're asking, how are you going to scale your business, and how are you going to compete with the data center behemoths,
Right.
like AWS?
Yeah, exactly. That's my favorite question. So the first part of the question I think I answered, which is, we'll have partnerships with financiers at the project level. Our projects are very profitable. If you have $30 per megawatt energy input cost, you can do a lot of things and make a lot of money. There's a lot of margin. So that draws in capital as long as the project is ready to build. So green projects draw capital. The second question is really my favorite question. So how does the little guy beat Goliath? Like, how are you going to compete with those big, huge guys? And the answer is twofold. Number one, we don't do what they do. That's the first thing. You are going to, yes, we're going after AI training, but we are going to go after AI training in a very specific niche. So we won't do very large, what's called foundation model training. And there's a lot of hype around AI, but I'm going to tell you all the truth. There's a 20,000 GPU installation. There are only 3 companies in the world that can do an installation that big. One of them is the government. So we're going to be focusing on the 500 GPU installations, 128 GPU installations, because most of the market, the big part of the market, is focusing on what is known as tuning. So they take a model that has already been trained, they give it a new data corpus that is typically proprietary data. So a great example is I have a data set that is about molecules. I have a model that helps me to find molecules that don't hurt humans when they're ingested. So I use that and train it on this data so it can find the molecules in my data set and my molecule library that will not be harmful for humans. And then I can focus all of my R&D on that drug discovery pathway. That is not a 20,000 GPU installation. It's a smaller GPU installation. And then the second thing that people are doing is they're taking small models. So they're training a new model that's smaller, that has less variables. And so the computing capacity that it needs is not very big. The benefit of that approach is that we can go place those types of compute in our environment. We'll be able to deliver it at a lower cost because all the bells and whistles that you would expect are different, and it'll be highly scalable. So most people start out with just doing some testing on modeling on their data, and then they figure out this is working really well, and then they want to feed it lots and lots and lots more data, and you can scale in our facility that way. The reason that works is because that is completely the opposite of the Amazon model. The Amazon model is to do big installations, lock companies into large committed installations. Even if you see the on-demand piece, fundamentally, they're going to ask you to do long periods. So our model breaks their model. And the way innovation works is you do something where the big guy has to kill his or her own business in order to come after you. And that's the trick.
John, thank you very much. We went over, so if we tired you out, we're actually taking about a 10-minute break right now.
All right.
If anyone has any other questions, feel free to approach him. Otherwise, thank you very much, John.
Thanks, everybody. Appreciate it.
To the virtual and in-person audience, we'll be back in about 10 minutes.
Hi, everyone. Thank you. Our next presentation will be from Eric Fry, VP of Finance at Gevo, which trades on the NASDAQ under the symbol GEVO. With that, welcome, Eric.
Thank you. So Gevo is a company that's based in Denver, Colorado. We've got a little over 100 employees, and we're a developer and builder and operator of low carbon chemical and fuels projects. We have our corporate headquarters in Colorado, as I mentioned. In Luverne, Minnesota, we have a demonstration facility. It's an ethanol plant, and also Gevo's proprietary isobutanol fermentation plant is there with behind the meter wind. There's a plant in Silsbee, Texas, that Gevo has a partnership around to convert alcohols to jet fuel and octane. So Gevo is one of the first companies to make sustainable aviation fuel using the alcohol to jet pathway at that plant. And then in South Dakota, that's our greenfield ethanol to jet sustainable aviation fuel project that you see in box number 4 there. So that's in Lake Preston, South Dakota. That's a project that Gevo has designed to be purpose-built, low carbon, using essentially the same technologies that exist today in the agriculture and ethanol industry, coupled with technologies that exist today in the petrochemical industry to convert ethanol to ethylene and convert ethylene to hydrocarbons. And then box number 5 there is an operating dairy manure renewable natural gas facility that Gevo has in Iowa. So a couple different components to what we have today, but they're all kind of tied together for the purpose of making and enabling low carbon fuels, particularly sustainable aviation fuel, from carbohydrates. So drilling down into those, looking at kind of the 4 activities that we do. The previous page is kind of our assets. We have our Net Zero 1 plant in South Dakota, as I mentioned, greenfield ethanol jet plant. In the lower right box, we've got our Gevo RNG facility that's operating that I mentioned. And then the lower left box, we have another set of activities that's basically R&D. So this is capital light technology improvements to design ultra low carbon plants that do ethanol to jet, and also better processes for converting carbohydrates to alcohols and alcohols to hydrocarbons. One of the technologies is what Gevo calls ETO, it's ethanol to olefins, and that's basically an improvement to existing technology to convert ethanol to hydrocarbons. It essentially skips a step. So you save capital, you save operating cost, and you reduce energy footprint, which means it's lower carbon. But that's an earlier stage technology that we're scaling up and commercializing in partnership with much bigger companies like LG Chem. And then the upper right box is Verity Carbon Solutions. So when Gevo kind of embarked on this journey to make low carbon sustainable aviation fuel, they knew that they would need an audit trail of sustainability all the way through the value chain, from the very beginning, the field where inputs are grown like corn, through the plant that processes it, whether it's using wind or renewable natural gas or other things to reduce the carbon intensity, and then all the way to the end customer. So if it's sustainable aviation fuel, that end customer is a seat on an aircraft. And you need an audit trail to be able to prove your claims about sustainability and to provide your customer assurance that what you're saying is true, but also to provide the possibility for continuous improvement along that whole value chain in terms of carbon and cost. So Gevo had to do Verity Carbon, and I'll talk about that in a little bit, but it's also kind of developed a life of its own, because we realized that other existing biofuels and other companies in our space, they need carbon tracking too through the value chain. There's about almost 60,000 acres and 20 farms through 3 growing seasons, and we've had 100% retention among our farmers who have allowed us to come onto their fields and collect their data. One of the things that's important in this industry is have a team that's multidisciplinary. So you have to bring together people with experience in agriculture, chemicals, traditional, petroleum, petrochemical industry, and regulatory, all under one roof. And so that's something that we've put together. Some of the people on the team have done things like this before. So CEO and COO created NatureWorks a long time ago. They created polylactic acid, which is kind of analogous to what we're doing. You start with fermentation and you make a chemical that's a substitute for an existing petrochemical, but from a more eco-friendly pathway. Gevo's had a lot of firsts in its history in terms of sustainable aviation fuel. I won't go through every single one, but just as an example, the first alcohol-to-jet sustainable aviation fuel flight was in 2014 with the U.S. Navy Warthog, as an example. So Gevo spent a lot of time proving the molecules and the processes and the pathways to do sustainable aviation fuel. What we're really focused on now is scaling it up to commercial scale and getting to economic projects that can then be repeated over and over to actually provide volume to an industry that has a lot of volume. So last quarter, we ended the quarter with about $400 million in cash and equivalents and restricted cash. We have more than 350 issued patents and a bunch filed. Some of those are related to Gevo's patented pathway to ferment carbohydrates to isobutanol, which is an alcohol. Other patents are related to designs for plants around fermenting ethanol and then getting ethanol to jet fuel, because you need both the technology and the design there. So we have patents around all those things. We have our RNG plant, and we have our Net Zero 1 greenfield plant site in South Dakota, and then our demonstration plant in Minnesota. That's currently in an idled state, but we're looking at how we're going to use those assets in the future. Skip to this. As I mentioned, Gevo, I think, is one of a very small number of companies that's delivered sustainable aviation fuel, in particular alcohol-to-jet sustainable aviation fuel, to a number of different airports and airlines in the past. And it goes beyond carbon too. The product that comes out of the alcohol-to-jet process that Gevo uses is lower carbon than petroleum jet fuel, but it's also got less sulfur. It's higher energy density. It's got much less aromatics. And those are all things that have sustainability attributes too when it comes to petroleum jet fuel. But the focus is on carbon intensity. The total addressable market for sustainable aviation fuel has really reached escape velocity relative to supply. So the US, for example, consumes something like 20 billion gallons of jet fuel per year. But globally, all the sustainable aviation fuel combined, in spite of a lot of talk and excitement, was more like 20 or 25 million gallons last year. So it's really tiny. But having said that, there have been about 180, 200 announced renewable fuels projects globally that are announced in different stages of design and construction. Some of those will make sustainable aviation fuel. More than 90% of that volume is expected to come from one process, which is called the HEFA process. That's a process that is kind of like what the refiners do. It uses fats, oils, and greases, or plant oils to make renewable diesel and SAF. Very few companies are focused on alcohol-to-jet, and alcohol-to-jet is a process that really unlocks another reservoir of feedstock that's sort of upstream and adjacent to HEFA. So it's really needed to unlock that to service all the SAF demand in the U.S. In terms of our cost, the far left shows price of petroleum jet fuel. So we're using round numbers. Maybe it's $2 or $3 a gallon, depending on where crude oil is trading. So our cash cost of production is going to be at a premium, but not a huge premium to that. But then when you add on the cost of our capital, that's going to be that box, that light green and dark green box on the right. So on a fully depreciated basis, the marginal cost to produce can be competitive. But for these first plants, there's a capital cost because you have to purpose-build plants that are low carbon. And then once they're built, once you have modular designs that can be repeated, we can start bringing the capital cost down. How do we get that? Well, on the right side, there's different ways, there's different revenue sources for that. Today, just based on existing environmental credits, we can we can service our capital for this project and service our cost of production. So the Net Zero 1 plant that I talked about in South Dakota, what does that look like? Essentially, the left-hand side of it is an ethanol plant. There's about 180 operating ethanol plants in the US. The US is the world's largest corn producer and the world's largest ethanol producer. So that's pretty well known. Our ethanol plant will be a low carbon design, so fewer BTUs of gas, of natural gas burned per gallon of ethanol that's produced. And then the right side of the plant is essentially chemical plant to convert ethanol to ethylene and ethylene to olefin. The inputs are important. You need a place where there's good wind. It's really windy in South Dakota. You can use the wind to use electrolyzers and make green hydrogen. Hydrogen's part of the process. You don't want fossil hydrogen because then you're not reducing carbon footprint. And most of what you produce through this process, you mill corn, you grind it up, and you make products. Most of that mass of bushels of corn goes to the food industry. So it's going to make protein. It's going to make corn oil. Protein mostly used for animal feed. It's the fermentable carbohydrate that's then fermented to make ethanol in the U.S. ethanol industry. And for us, we'll take that ethanol to jet fuel. So if you think about what is the future, our goal is to have patented designs and modularized designs so that we can repeatedly build either full integrated corn to ethanol to jet plants, or going forward, a combination of just an ethanol to jet plant side by side with an existing ethanol plant. There's a number of ways you can do that, but the goal is for this to be repeated. If you look at most projections for fulfillment of SAF demand in the U.S., that red and blue over there is basically alcohol to jet pathways, and the green at the bottom is HEFA. So more than 90% of SAF volume from announced renewable fuels projects globally is from that green pathway. And there's basically a ceiling of how much feedstock is available from that pathway. So we're going to have to go to alcohol to jet to unlock more feedstock. U.S. ethanol demand is in long-term decline because of the electrification of passenger vehicles. So there's also going to need to be another use case for ethanol. And aviation fuel is a good use case because it's hard to electrify. So how does Verity fit into all that? Like I said, to do all this, it's important that we track from end to end the sustainability criteria and the carbon footprint of what we're doing. It needs to be auditable so that if there's a regulatory market, we can prove what we said actually happened. The wind doesn't always blow in South Dakota, so did that gallon come from wind or not? So Gevo did this, set this up with a team of software engineers and people understanding agriculture and regulations, originally for our own project because we knew we'd need it. The idea is that you have data being collected, massive amounts of data in the U.S. ag industry at the field level, not just each farm, but even each field within each farm that's owned. And each field may have different criteria each growing season. So it turns out that the difference in carbon intensity, a contribution to biofuels of one field versus another, we've measured it to be as much as 30 CI points. And to give you a sense of scale, that's the same impact as doing carbon capture. So there's a meaningful difference between just national average growing practices and what actually happened between the variation among different fields. So it's critical to actually measure that and have an audit trail for that. That's what Verity tracking is designed to do. So because Gevo is developing it for our own project, others in the biofuels industry want to use Verity, so it's kind of developed a life of its own. In the past several months, we've announced 3 different ethanol customers that make up about 2% of the U.S. ethanol market, which is a big market. So that's growing independent of Gevo. So it's kind of an independent business that has its own customers in addition to Gevo. Our renewable natural gas plant in Ohio that has 3 dairy farms linked up by pipeline to a gas upgrade system. So it's essentially, this is manure that would emit methane. Methane's a very potent greenhouse gas. We capture that methane, run it through an anaerobic digester, and that's the way we capture the methane that comes off the manure, clean up the gas so it becomes pipeline spec, and then inject it into the local gas system. So that's a cash flowing asset. We think it'll get more cash flowing next year when we get our permanent carbon intensity score in California. And we just completed an expansion of that to about 400,000 MMBTUs per year. So the last piece is our specialty chemicals and technology and licensing activity. So this is a capital light sort of R&D and licensing related activity that we do given our team's background in fermentation technologies. One of the, you can see in this on the left side, Gevo, our Net Zero 1 project does an ethanol fermentation, so that's 2 carbon atoms with an oxygen. Gevo's proprietary fermentation that has its own genetically modified yeast gives you isobutanol. So you get, that alcohol is 4 carbons plus an oxygen atom. You can see the 4 gray balls and the 1 red ball, that's 4 carbons and an oxygen atom. So that's an interesting molecule because you have fewer oxygens you have to tear off per carbon. And the goal of petrochemicals and petrofuels is to get chains of carbon atoms, basically. Gevo has an improvement to the process for converting ethanol to these other molecules like ethylene and propylene that they call ETO. I mentioned ethanol to olefins. It basically skips some steps to get you there quicker and save cost and save energy. And if you save energy, you're reducing fossil footprint. So we have a partnership with LG Chem, specifically using the ETO technology to scale up and commercialize biopropylene. And that's an example of a molecule that you can use to make a large number of diapers to bumpers on electric vehicles. So that's an activity where Gevo partners with a much larger company for scale up on a more early stage technology. The Net Zero 1 project that I mentioned before in South Dakota, that's using technologies that already exist in a lot of different forms at scale and just putting them together in a special configuration to reduce carbon footprint. So that's pretty much a summary of Gevo. And if there's any questions, I'd be happy to answer.
All right, hold on. Eric, with rolling out Verity, what other applications or sectors does it make sense? I mean, obviously you're applying it to SAF with corn, but if you look at some of these other markets that are out there, is it going to be a similar process, similar rollout? You have obviously the corn market today to be able to use it as an example, but as it applies to multiple feedstocks, is that right?
Yeah. So the basic idea applies to anything where you have a renewable, a non-fossil input, and you're trying to make a product that has a lower carbon footprint than the fossil alternative. So all the things that are on this screen would be examples of places where we could use Verity. Ethanol is a good starting point just because there's a lot of shots on goal, basically, to reduce carbon footprint. There's a lot of data that's already collected in that supply chain, but it's just not utilized in this way. And no one's checking to make sure that there's no gaps and that kind of thing for all the inputs that you need for someone to look on like an iPhone or something and say, here's my carbon intensity score. So it requires a lot of, doesn't require a lot of capital. It requires a lot of, brain power and time and persistence. But you could do that in other industries. It's just ethanol is kind of a good starting point.
You talked about your RNG plant and how that's been growing and doing quite well. Do you have plans to expand and do that elsewhere in the country?
Yeah, so we've been really focused up to this point on that plant, debottlenecking, expanding, and then getting our permanent carbon intensity. I think at our core, we're a carbohydrate to hydrocarbon company. So, so things like sustainable aviation fuel are kind of our core. But at the same time, RNG is a profitable activity. There's a lot of targets out there to do anaerobic digestion, to do RNG. I think we are looking at growing that and expanding that either organically or inorganically. And there's a lot of ways to do that, but we have to be judicious because we don't want to lose sustainable aviation fuel. At the same time, we don't want to lose a missed opportunity to grow in that region, for example, and leverage what we're already good at in terms of doing dairy RNG. So short answer is yes.
Eric, hi. On your feedstock waste, there's a huge footprint of poly waste in the Pacific. I would say it's like 400 square miles. Is that of interest? Are you looking at that?
So that's not a target that we have right now. When it comes to waste, like municipal solid waste or plastic waste floating in the ocean, that's a little bit far afield of our starting point today. In principle, there are companies that are taking municipal solid waste or taking medical plastic waste and other forms of waste and using other processes and technologies to make value-added products. Those industries, those emerging industries, would be a potential next set of customers for Verity tracking in terms of carbon tracking, but it's not a focus of Gevo today.
Eric, we have a question from one of our online attendees, and it has to do with your IP portfolio. And they're asking if you can kind of reconcile what they see as a disconnect between the value of your IP and your current market cap.
Yeah, well, so the short answer, I guess I would say is, for me to reconcile the disconnect, I guess I'd have to say that it should be disconnected, and I don't think it should be. I think there is a disconnect. We have demonstrated. I think Gevo has an unassailable IP portfolio on isobutanol. There's pretty much two ways to do alcohol to jet. You can make ethanol and then do sustainable aviation fuel or isobutanol. And Gevo kind of has IP around the first way and is a first mover on the second way. So I think the disconnect is sort of, from our perspective, profound. Our view is we are well capitalized in terms of our development pipeline and what we need to do to execute. We don't believe that we need a lot of capital. We think it's only a matter of time before that disconnect sort of solves itself, because the demand for sustainable aviation fuel is inevitable in our view. The need for alcohol to jet is critical. We don't think it can happen without alcohol to jet in our view. And sooner or later, the world's going to not just talk about fuels, but they're going to talk about all the materials that come from petrochemicals too. And things like ETO play into that. Not to mention the plant design. In the early 2000s, the U.S. built dozens of ethanol plants when that industry kind of exploded. We think that there will be like another leg to that, where you're going to want to have modularized, patented designs for a low carbon ethanol plant and an ethanol to jet plant, and we want to take advantage of that too. So our patent portfolio we see as having a lot of value, and there is a disconnect, and our goal is to really rectify that through execution.
Thank you. And there's another question asking for an update on funding for NZ1 and backup funding plans as related to startup.
Yeah, so the key anchor for funding for Net Zero 1 is the Department of Energy Loan Guarantee Program. Although we expect to do parallel path, syndicated bank loan markets as well, and private credit markets next year. But the long path item is the Department of Energy Loan Guarantee Program. We think that construction needs 24 months after financial close, and we think financial close will take us well into next year. We started the formal due diligence process with DOE when they invited us to term sheet negotiation and due diligence a few months ago, and we essentially need them to finish, onboarding their advisors, their financial advisor, their engineer, their independent engineer, their legal counsel, all that stuff, and then complete their diligence work for us to get to financial close. So that's the timing, and the timing will basically fall out of that. In the meantime, Gevo expects we think a significant amount of what we spent on Net Zero 1 is repeatable. It's generating an asset that'll help us repeat the project in terms of the design, the modularized design of the facility. So we'll probably put, I think we've guided to anywhere between 50 on the low end and $100 million on the high end of capital between now and financial close, well into next year.
All right, Eric. I think that's it for today. Thank you for your time.
Sure. Thank you.
Thank you, everyone. Our next presentation will come from Craig Shesky, Chief Financial Officer of the Metals Company, which trades on the NASDAQ under the symbol TMC. Welcome, Craig.
Thank you very much, Graham. Thank you to the Water Tower team for having us. Yeah, it's a very exciting time to be talking to you. A lot of developments that have been happening in this industry, really not over the last several years, but really the last several weeks. There's been a lot of progress, both with respect to the US government, with respect to progress on our environmental data collection, even the news that Norway is going to be opening up their exclusive economic zone for exploration and then exploitation of seafloor resources. So the industry is having a moment, but if you take nothing else away from this, it's that the resource we're developing is very large and very high grade. It's in the form of these polymetallic nodules that sit unattached on top of the seafloor. And what TMC is developing is a resource that has enough nickel, copper, cobalt, and manganese in situ to electrify every vehicle in America, roughly 280 million electric vehicles at an NMC 811 cathode chemistry. So it's big. It's something where the technology to collect the resource has now been proven. The technology to process, and in fact, the partnership to process this resource has now been achieved as well. And now we're waiting on the final piece of the regulatory puzzle to fall into place. And it's going to be a very exciting next couple of years as we get ourselves into production estimated for the end of 2025. This is what a polymetallic nodule field looks like. So these nodules, you'll notice, are very small little potato-sized rocks that are chock full of the battery metals that we need for the clean energy transition, including nickel and copper and cobalt and manganese. But one thing you'll notice here is that the nodules are not buried. You can see them, this is a couple meters above, but you can see them just laying on top of the seafloor. So in order to gather this resource, you don't have to dig or blast or drill. They can merely be collected, and then they ride up on a riser pipe to a vessel waiting on the surface. So this is called deep sea mining, but the actual mechanics of picking up this resource is very, very different. Now, when people talk about deep sea mining, it often gets thrown into one big bucket. What Norway, for example, announced in their exclusive economic zone would be cobalt crusts or seafloor massive sulfides. It's a different type of resource. It's in shallower waters, areas that have more life per square meter. What TMC is interested in is just polymetallic nodules. Polymetallic nodules which lay roughly 4,200 meters below the surface in the Clarion-Clipperton Zone of the Pacific Ocean. And why go after nodules? Well, they're polymetallic. That means multiple metals in one resource. And in fact, when you roll together all of the metals, it's 3.2% nickel equivalent, which would make it one of the largest grade projects on the planet for nickel. It's far offshore. It's not in anybody's backyard. It's very deep. It's in an area of the planet actually where there is no photosynthesis. There's no plant life. That means there's limited animal life as well too. But we've been spending a lot of money on actually analyzing that seafloor area, determining what the environmental impacts are. And a lot of that data is just starting to come out, and we're very encouraged by what it's saying. Why explore the seafloor in the first place? Well, that's where a lot of these metals exist. For nickel and cobalt and manganese in particular, the US Geological Survey came out with a study in 2020 noting that there is more nickel estimated and more cobalt and manganese estimated in the Clarion-Clipperton Zone of the Pacific Ocean than all land-based reserves combined. Now, yes, this is comparing apples and oranges because what we have in the seafloor is just at resource stage, not yet proven to be reserves. But as we do our feasibility work over the next year, we'll have more to say on that front as well. And again, if we're just talking about how many EV battery cathodes can be put on the road with this resource, TMC's 2 contract areas alone, both of which are Canadian 43101 and SEC SK1300 compliant with third-party independent verification of this resource, there's enough metal down there to electrify every vehicle in America. Relative to some of the other undeveloped nickel projects on land, this is quite a bit bigger and quite a bit higher grade. And mining.com, apologies for the formatting, it looks like the PowerPoint has done a little dance there on the right side of the page, but I think you'll get the gist. This is one of the largest battery metal projects on the planet. And in fact, mining.com for the last 2 years in a row now has ranked us the #1 and #2 largest undeveloped nickel project. But one of the things that's really great about this resource is the grade. And talking about a resource development project like this, something that is so large and so high grade, that tends to get developed. And it's the type of resource that if it were on land, it likely would have been developed thousands of years ago. People go after the high grade projects first. And relative to many of the other undeveloped nickel or battery metal projects on land, this one is very high grade. That means our economic costs are relatively low. It also means that, in our view, the environmental costs and the environmental impacts are also lower because you're moving less material to get the same amount of metal, and you're doing it in an area of the planet that has less life than any other biome. We are not the only ones doing this. I mentioned Norway announced that they are beginning deep sea exploration and exploitation. Japan will actually be looking for seafloor mud, looking through seafloor mud for rare earths beginning in 2024. And Transocean and Oil States and Technip and other people in the offshore oil and gas space have been devoting assets to the collection of polymetallic nodules. And one of the countries doing that mostly in earnest is China. China has 5 polymetallic nodule exploration contracts, 2 of which are in the Clarion-Clipperton Zone. And the Washington Post did a deep dive on this back in October. And while they found that TMC is still the leader in technology, China is coming. And that's pushing the regulator to continue to do the international negotiations necessary to open up this industry and make sure that environmental protections are in place before mining actually begins. There's also been a lot of news in the US House and Senate. In fact, the House Armed Services Committee, recognizing that the US is really behind the 8 ball when it comes to primary production of nickel and manganese and cobalt, the House Armed Services Committee actually directed the Pentagon to deliver a report on how the US can do more to incentivize production and refining of nodules domestically. And while the US is not a signatory to the UN Convention of the Law of the Sea, the US is not a member state of the International Seabed Authority, who is our regulator. There's nothing that precludes a company like TMC from delivering these nodules to US shore and take the United States from effectively 0 primary production of nickel, manganese, and cobalt to self-sufficiency in all 3. And we can do that from our first project alone. This is not a new technology. This is not something where you're comparing it, let's say, to shale or even oil and gas in the 1960s, where you went from 0% coming offshore very quickly to 1/3 of the market. Well, the technology to do this for nodule collection has been around for a while, and the basic element of a drill ship, a riser pipe, and then a collector vehicle on the seafloor was actually proven back in the 1970s by companies like BP, Shell, Lockheed Martin, Sumitomo, Mitsubishi, US Steel. What they didn't have at that time was a regulatory environment to allow production to occur. The United Nations had to first establish where are the borders of a sovereign's territory when it comes to the oceans. What they established with the UN Convention of the Law of the Sea in 1982 was that within 200 miles of a sovereign's coast, they have economic rights to it. Anything beyond that would be considered international waters. So that was the first step. The next step was, all right, how do we decide who gets to do exploration and then eventually exploitation in international waters? Well, that's the formation of the International Seabed Authority. And the International Seabed Authority is a group of 168 member states plus the European Union that was set up in 1994 to start answering those questions about who gets to explore for the deep ocean. Now, what you see on this map is the Clarion-Clipperton Zone. And think of this really as the Goldilocks zone, where these nodules form in high abundance with high grades, in particular of nickel and copper. That's what drives the economics of our resource. And in fact, nickel will be approximately half of our revenue once we begin production. What TMC controls are the yellow, the blue, and the red blocks. And you'll notice there are other white blocks around too. Those are represented by other sovereign nations for the most part, such as Germany, France, China, Russia, Japan, Singapore. The reason TMC is out here is that the UN, in establishing this, wanted to make sure that this is not another industry dominated by rich, northern, often former colonial nations. They wanted to make sure that the ISA member states that had developing status could also get access to this resource. So for every contract that would be granted to a China or a Germany or a France, the exact same size, 75,000 square kilometers, and exact same economic value contract would be put into a land bank. That land bank could only be touched by smaller developing nations that were member states of the ISA. After about 10 years, the regulator realized, well, this land bank was not getting utilized. So they began allowing private companies to partner with nations that have developing status to bring this resource and bring the benefits of the resource to those developing nations, whereas the contractor is the one taking the risk, putting up the capital, doing the research, and getting the process all permitted. So that's how TMC became the first contractor to take advantage of this system and allow us to partner with a developing nation that really has been a wonderful partner. Nauru is one of the smallest nations in the world. They're actually decimated by phosphate mining over the course of many decades. And now this is an opportunity for them to increase capacity building and get access to a very large resource through royalties that TMC would pay to them. In fact, we estimate that as we begin production, the royalty for Nauru would approximate more than a third of their GDP per year. So this is an example of this system working exactly as the International Seabed Authority intended it. It's a resource that's quite easy to actually determine how much you have of it. We have a inferred, indicated, and measured resource of 1.6 billion tons. And that's not only from sampling the seafloor at regular intervals, but also you can take images of the seafloor. You can actually use bathymetric survey data to determine where the nodules exist because there is no plant life. It's too deep and it's too dark. So what you'll see on the lower right is what some of that high-res imagery looks like. It's kind of like a big QR code. It's dark where the nodules are, it's light where the nodules are not. So that's why we have such confidence in the size of the resource. In terms of the technology, again, deep sea mining puts in our head this thought of, I know what mining's like on land and there's blasting and there's digging and drilling. Well, that's not what this is. This is a resource that sits on top of the seafloor. It's effectively two-dimensional. So this is the collector vehicle going over the top of them and really sucking up these nodules and leaving as much of the sediment behind as possible. Now, this was from GSR, the Belgian contractor, in 2021 with a good upfront view. And now what I'll show you is TMC's own production system put together alongside our partner Allseas, who is nearly a 20% shareholder in TMC. We did our successful testing of this system over the course of 2022, culminating in the first deep sea nodule integrated collection test since the 1970s. That is our collector vehicle being launched off the side of this vessel. The vessel itself is actually a Samsung 10,000 drill ship. And this is another great thing about this industry. You can take existing assets that have been used for oil and gas exploration for a decade or more and repurpose them for the collection of a resource necessary for the clean energy transition. And that's why companies like Allseas and Transocean and Oil States and others are so eager to get involved in this space and really put forth some of the assets and the talent and the capital to back a new industry. What you see here is 86 tons per hour of sustained production rate. We and our partner Allseas, as we get ready for commercial production at the end of 2025, are upgrading the system for a maximum capacity of 3 million tons per year. And how we're doing that, it's not any real magical technology. It's really just putting in a wider pipe, adding a second collector vehicle, and putting more powerful compressor spreads on top to allow us to pump more air down on which the nodules ride up 4,200 meters to the surface. That's what 3,000 tons of nodules look like in the hold of our vessel. This is less than 1 day's worth of full production, but this was the culmination of a very successful collection test. But at the same time, we also had a vessel behind this collector system that was actually tracking what are the environmental impacts pre, during, and post-collection. And a lot of that data is starting to come out as well, and the impacts of nodule collection are shown to be quite a bit lower than what they are for getting the equivalent amount of metal from other sources on land. When it comes to processing, it's another situation here where we can use existing assets. And we actually demonstrated at XPS's facilities in Sudbury, Ontario, the processing of these nodules into a nickel copper cobalt alloy, and then a nickel copper cobalt matte, along with a manganese silicate product that would go directly into steel making. Takeaway is here, it's a proven flow sheet. The processing is something that we've already proven. And now we have an MOU in Japan with Pacific Metals that have been smelting nickel laterites at this facility since 1965. So it's not a situation like on land where you get the permit and then it's time to go start building. And 3 or 4 years later, and many billions in CapEx later, then you're able to start. This is a situation where once we are permitted to begin, we already have the drill ship lined up. We already have a partnership with a binding MOU that would allow us to process the nodules from that first vessel. So really, we can be up and running in commercial operations within several months rather than several years after getting the permitting. Our pre-feasibility work is well underway. We anticipate releasing that result around the middle of next year. Bechtel is helping us put together our techno-economic studies, and we're also looking for more definitive agreements with Allseas and PAMCO to be reached in the coming months. We've spent already $150 million on our environmental and social impact assessment over the last 12 years and 20 environmental research campaigns. In fact, the 20th of those campaigns is ongoing as we speak, and all of that data is then going to be put together into our environmental impact statement, which is one of the key linchpins for our application to the regulator, which we plan on launching after the July 2024 ISA session. So it takes about a year for them to review our application. So assuming that 1-year review process, that lines up with our timeline to begin commercial operations by the end of 2025. Now, just a little bit on the environmental impacts, given that this has been a topic in the news over the last couple of years. A lot of people are looking to say, well, I have this paradigm of mining, and putting that underwater seems like it could be something that leads to impacts that we haven't necessarily thought of. The reality is these nodules exist in an area of the planet with less life per square meter than anywhere else on the planet. And if you're talking about biodiversity, excluding microbial life, it's also the least biodiversity of any biome on the planet. And in order to protect something like this, where it's very common over very wide areas, like the Clarion-Clipperton Zone is, you can protect it through conservation. And that's exactly what the International Seabed Authority has done. They've set aside roughly 43% by area of the Clarion-Clipperton Zone that will never be touched. So to the extent we learn more about this ecosystem, and if there are certain organisms, bacteria, et cetera, that are living around these areas, they're still going to have plenty of places to thrive around the areas where mining will be occurring. Compare that, of course, to Indonesia, which is the main game in town when it comes to nickel supply growth on land. Indonesia is actually the area of the planet with the largest species richness. So it's really two ends of the spectrum between the life that could be impacted from mining, whether it's nickel on land or nickel on the sea. And in fact, our friends at Benchmark Minerals put together an independent life cycle analysis comparing, hey, let's stack up for nickel and copper and cobalt, all of the potential impacts, and compare this to other land-based routes. And what they found is for nickel and copper, every single impact category that was analyzed, nodules from NORI-D were the lowest impact on that scale. And that applies for CO2 emissions, deforestation, tailings. It applies for ozone depletion, acidification, water use. This is the lowest impact of anything that they measured. And then one of the things that gets a lot of attention is the seafloor plume. Certainly we're in an area of the planet where there's not a lot of life on the seafloor, but what were to happen if, when we're collecting these nodules off the top of the seafloor, the dust that gets kicked up, what if that traveled further? What if that traveled further up the water column? Because that's where most of the life in the ocean is, over 90% of it, closer to the surface where there's more light, there's more energy. So there has been speculation that the dust clouds from mining could get kicked up and then travel for many thousands of miles. In fact, some people have speculated tens of thousands of miles. Well, now the results are coming in, and that has proven to be patently false. The plume from collecting nodules, 92 to 98% of it stays within 1 to 2 meters of the seafloor and falls back down. What you see here is our collector vehicle in our test late last year. That's about 3 meters high, and you can see the plume forming a turbidity current, effectively staying close to the seafloor under its own gravity as the particles flocculate together. So that's a lot of scientific verbiage that I myself need to break it down and to just say it's basically behaving more like a liquid than it does a gas. It does not waft higher like you might expect smoke or a gas type of plume with a solid within inside of it. This is actually something where it stays close to the seafloor and acts more like a liquid. So that means if you're not wafting further into the water column, you're not affecting the animals that will be closer to the surface. And in fact, a lot of this data is going to be shared in real time with the regulator, the International Seabed Authority, and with all of you and everybody listening in and all stakeholders around the world. You'll be able to go to the portal online and see this dashboard for the plume and many other impacts, showing how TMC is staying within the threshold set by the International Seabed Authority. And what you see here is the collector vehicle, a model of it going a few hundred meters back and forth. And the plume, not only does it settle within about 1 day and stay within a couple meters of the seafloor, the blue and the purple bands would effectively be clear water to the naked eye. So all of the environmental data is now being released, and we're very happy with what it's saying. And again, we have a cloud-based AI system being developed with Kongsberg in Norway that will allow us to get better and better and better as more information is fed into the system, making sure that there are guardrails on the operation, and all of this is reported in real time to stakeholders and the regulator. This is how we start small, we do it smart, and we make sure that as we ramp up, all of this data is then fed back into the system to make sure we continue to get better at minimizing these impacts. Now, the International Seabed Authority, represented by 168 member states plus the EU, they are the regulator for this industry, set up with the dual mandate. First, to deliver exploration regulations, which they did in 2001, and then to deliver exploitation regulations. Now, they had a target of having that done in 2020. COVID happened and they didn't meet for the better part of 2 years. They then set a new roadmap date of getting the exploitation regime done by July of 2023. They did not hit that deadline either. But what they did reach in July of this year was a compromise between various member states to have 3 more meetings on the calendar, one of which has already occurred. The next one would be in March 2024, and then another in July 2024 to further progress the regulations. As the Secretary General of the ISA, Michael Lodge, said recently in a Wall Street Journal interview, and to paraphrase it, the shape of the document is becoming clear. That, yes, there's going to continue to be dotting of I's and crossing of T's. There's going to be continual debate on the financial regime, but we are now dealing with what is going to be one consolidated text as we get closer to this finish line. And we believe it's in good shape. And that's why TMC has confidence that after July of next year, we'll be in a position to launch our application. And the ISA would consider that application. It first goes to review by the Legal and Technical Commission. That's 41 subject matter experts who are used to looking at resource projects and environmental impact statements for projects on land and sea. So if they give it the green light, you would then need a 2/3 majority of the ISA Council states to vote against that positive recommendation to prevent us from going forward. So there are a lot of reasons that we have confidence that this is going to push forward. And yet, when you're talking about what is TMC trading at as a percentage of the underlying asset value, we are still, in our view, only trading at about 3% of the underlying net present value of our first block alone, what we call NORI Area D, which had a third-party independent NPV of $7 billion calculated in early 2021. And that, again, is less than a quarter of our total resource. So where land-based developers might be trading at 30, 40, 50% of NPV within 2 years of production, we're still trading at a major discount. So we think, of course, there's a disconnect because people haven't seen the ISA grant one of these exploitation contracts yet in international waters. We strongly expect to be the first one. We think the science is now moving in our favor, and that data is going to continue to be released over the coming months, building confidence from other contractors, sovereign states, investors, and it's a very exciting time to be doing work on the TMC story. So I think we have about 4 minutes left. With that, I might open it up to questions from the audience here and perhaps some from the folks online.
Took the words right out of my mouth.
Greg, just a excuse me, quick question. The campaign that you're currently running, which comes a year after your collection test was done, what is the purpose of that campaign? What are you hoping in terms of scientific data that it will deliver, and how will it impact the understanding of underwater, and deep sea mining?
Yeah, absolutely. The point of this 20th campaign is to measure the environmental regeneration within the area at and immediately near to the collector test from late last year. What we see from preliminary findings, and you should expect more in the coming weeks on that, is that there is life coming back to the area. And one of the key things that's being measured is how many millimeters of sediment has been deposited over the area, and how has the biodiversity reacted to that sediment settling. And you'll be able to see images, you'll be able to see video, and you'll be able to see raw data, which we'll be submitting directly to the ISA and the Ocean Biodiversity Information Database. So all scientists around the world will be able to corroborate some of the initial findings.
That's very helpful. And then if I can follow up on the environmental part, because that seems to be a sticking point both with the stakeholders and the ISA member states. The data that you're collecting and you are posting to worldwide resources that are accessible to everybody, could that data be used for environmental applications by other parties in the same area?
It could, and we think that's the system working exactly as it should. One contractor builds on the data from another contractor, everybody shares it very openly, and we all get the best data possible. And this leads us to saying, okay, well, now we can adjust what the collector does. And here's how we do it to make sure sediment intake has been minimized. All of that data sharing is something that we're very excited about. What it can't do is accelerate the fact that other contractors still need to do a minimum of 3 years of environmental baseline research in their contract area before beginning work. So they can use some of our conclusions to help their hypotheses, but you still have to put the assets in the water and just, let the environmental baseline work continue. So this isn't something where we're sort of running through the wall first and then everybody gets to come in right behind us. Everybody still has to do that 3 years of environmental baseline work before they can be in a position to launch an application for exploitation.
Craig, can you draw some kind of comparisons between traditional land-based mining and seabed mining, from permitting to moving to production to all-in sustaining cost?
Sure. Yeah, I'll move to the cost curve. Look, I spent a lot of time researching land-based mining companies on the buy side. What I would say that's very attractive about this resource is you do have the ability to do it in a very capital light way. Typically, the deposits that you have for base metals, including nickel and copper and cobalt, are moving further and further away from population centers. Because certainly stuff that was high grade and closer to where people live, that's what people find first, and that's what is mined first. So as we go further and further into jungles and deserts, it becomes harder and harder. And frankly, you have to take the infrastructure with you, building out railroads and roads and water and ports, et cetera. But there is a comparison in terms of, all right, let's say, what is your cost of production for a particular metal as a benchmark? And for nickel, we would be in the first quartile of the cost curve. So relative to land-based mining on land, relative to other land-based miners, we think our costs stack up very favorably. But one of the key elements of this that's very attractive is flexibility in how we ramp up production. And whereas you're usually talking about at least 3 years of building after you get your permit, we can be up and running within a couple of months after receiving that. So it is more of a question of how many ships are available and can you get those ships on the water. But taking advantage of existing processing and infrastructure, like we plan on doing first in Japan and then potentially other areas, and maybe one day the United States, that is something that makes seafloor mining unique.
Thanks. Great presentation. Thank you. You talked about trading at a major discount, land-based versus seabed mining. Could you possibly give an estimate of what's the cost per ton compared to land-based mining?
Yeah, well, look, per ton, the scale actually shows is what the relative cost per pound is. So because this is such a unique resource and you have 4 metals in one rock, you can't just say, well, what's the cost of nickel? What's the cost of cobalt? Think of it as like we're going for nickel and we happen to get cobalt and copper and manganese for free. What I would say is that if you're talking about the full steady state production model put together by AMC, their view is that our EBITDA margin would be over 60%. So that's a multiple higher than what an expected EBITDA margin might be for a very mature mining company on land. We will take an opportunity to maybe trade some of that margin to people who are willing to put up the assets to allow us to get into production and ramp up quicker. So that's going to be part of the capital light model, and we talk with Dimitri quite a bit about that. That's what makes sense now. When we're talking about a depressed share price, certainly relative to the underlying resource value, getting ourselves into production in a capital light manner then allows us to show the world exactly how profitable we can be. And then they start extrapolating to say, all right, TMC can do this model on one ship. What does TMC look like down the road when there's 10, 15 ships or more in the future? So we think the costs do stack up favorably. But again, it's not anything special in the technology. It's really something special in the resource. And that's the high grade of all 4 of those metals wrapped into one resource. Sure. Look, there's a question about whether we're looking to acquire or be acquired. We are devoting every dollar that we have, and we have quite a bit of liquidity available to us. We have partners with deep pockets who, every time we've needed to raise money, have answered the call. But we are not in a position where we want to be out there and trying to acquire other people, certainly until we get to the point where we get our application across the line. In terms of whether or not we are an acquisition target, I would say what we view as the fair value of our asset is quite a bit higher than where we're trading at. And given the fact that roughly 50% of our shareholder base is affiliates and insiders, all of which are playing for something quite a bit higher than what the public markets are putting in now, I don't think you should expect for us to be a takeout target anytime soon. But of course, we are fiduciaries. It's our duty to represent the interests of our shareholders as it is for our board. So any proposals, of course, will be considered, but we have a good idea what this is worth.
And Craig, in the interest of time, we're unfortunately out of time. Thank you very much. Thank you for your presentation.
Thank you very much. Appreciate it.
easier just Hello. Our next presentation will be from Michael Costa, Chief Executive Officer of Base Carbon Inc., which trades on the OTCQX market under the symbol BCBNF, as well as on the NEO market under the symbol BCBN. Welcome, Michael.
Thanks, everyone, and thanks, Water Tower. This is a super cool event, and really glad to be partnered with you guys and working with you guys going forward. There should be some forward-looking statements in there, so the normal disclaimers for everybody. But given it's our first time with the Water Tower investor base, we thought we'd just give a really simple overview of who we are as people, what Base Carbon is as a company, how we started, to really level set for everybody as we get into the environment and the ecosystem that you guys have and you guys are building. Very simply, Base Carbon, we're an upstream producer of voluntary carbon credits. Really, really simple business. We've got 3 projects that are on the books right now, 2 household device projects. I'll get into those and talk about what those are. 1 afforestation, reforestation project. And those projects either distribute clean cooking devices, plant trees, and by doing so, either reduce the amount of carbon in the atmosphere or actually sequester carbon out of the atmosphere. And in doing so, reduce the amount of carbon in the overall atmosphere. Very good for the environment, very good for net zero, very good for Paris Agreement, 1.5 degree target goal. And the result of that is we have an economic widget that can be sold to all the net shorts in the marketplace, whether they be oil and gas companies, potentially even sovereigns, pursuant to Paris Agreement, Article 6, yet to be adjudicated. So again, really, really simple business for us. From a high level, we're talking about upstream commodity producer, voluntary carbon markets. Right now, before we get into all the detail of our projects and what Base Carbon is, for me, as an ex-portfolio manager, and I'll get into my background in a second, I think framing the opportunity and what you need to believe right now to underwrite the story is really, really important, and where you believe their upside in the story. We trade for about a $35 million enterprise value on our. Sorry, I keep getting distracted. It's very distracting with the door. So for the people online, sorry about that. We have a $35 million US dollar enterprise value on one of our projects, on the phase 1 of our project in Vietnam, with a major US FI as our off-taker and Citibank. The remaining part of phase 1, which will happen over the next 12 to 18 months, will yield back to us, north of $30 million US dollars. So when you think about just a very simple sum of the parts as a get-go from where we trade right now, it's an incredibly compelling value proposition. I'll get into the projects themselves and talk a little bit about valuation, talk a little bit about the productivity of the projects, but fundamentally, we see not only the ability for multiples of money returns in the base case in our projects. There's certain upside case, positive risks in the market that we've exposed ourselves to in these projects. Talk about one of them in our Rwandan project that's actually, as of today, come to fruition, that we're really excited about. So this is a business where you don't really need to believe, and you don't really need to underwrite a lot to underwrite it at the current price. In the base case, there's lots of opportunity for multiple of money return, and there's lots of exposure to upside. So in doing all of that, the question then becomes, well, who's doing all this? What are those upsides? What does this portfolio look like? What does Base do? So going back again to simple business, underwriting upstream projects, we're allocating capital in these projects. We raised to date about $50 million US dollars, 40 million of which we've allocated or committed across this portfolio of 3 main projects. In our team is comprised of people who come from carbon itself, people who come from finance, people who come from investing, portfolio management backgrounds. Carbon, what we've learned in a very short amount of time, is an industry which, and voluntary carbon specifically, requires a whole plethora of skill sets. There's not a skill set out there. So you need a risk management skill set. You need a deal process and due diligence skill set. You need an ongoing asset management skill set. And then on top of that, you need the carbon overlay, which I bifurcate into. You need the ability to develop projects. Have you actually developed projects, understand EM risk, understand how to manage those risks? And then number 2, do you actually understand the carbon markets? Do you understand the policy? Do you understand what's going to be valuable? One of the concerns within the VCM that we've seen is, and one of the what's the right way of saying this, the fallacies that we've seen others go about it as, is they think about it as a commodity that they just go out and they create length. That doesn't make sense to us, and it never made sense. So we endeavored on this business to ensure that there was either offtake or no ability in our projects in terms of what the structural short in the carbon market was going to be and what we'd be delivering into. It wasn't just simply about, oh, let's go make some carbons and somebody will buy it someday. That's, we've learned or observed in other businesses and other capital allocation ventures that's a really, really simple way to go bankrupt really, really quickly. And we did the opposite. We really focused on where the market was, where there was underwritability, where there was no ability, and we kept our portfolio really simple and avoided a lot of the flashy projects, and that's turned out to be really well for us. In terms of background on our business, for me, as I mentioned before, I'm an ex portfolio manager. I spent the first decade of my career at Goldman Sachs, just across the way here, but that building wasn't built when I started at Goldman. And I had hair back then. But I spent the first decade of my career there. I was primarily in a business called the Special Situations Group, largest on-balance sheet principal investing business within the firm. We did everything from specialty lending through to oil and gas finance and other commodity finance, through to buying derivatives from airlines, through to just common equity investing, middle market private equity, everything in between. So really capital structure agnostic, deal structure agnostic, industry agnostic, risk reward centric. We did things like build CLOs, which I think as time goes on in a business like this, I think is really, really important when you think about the tranching of risk that will need to happen for the voluntary market to grow into what it needs to grow into to meet the 1.5 degree goal pursuant to the Paris Agreement, and all of the different pieces of finance that'll come together and equity finance that are necessary for that industry. From Goldman, I went to UBS. In SSG, I ran Goldman Sachs' Canadian investing business. So my portfolio was about $1.5 billion, give or take. I went from Goldman to UBS, ran their Canadian investing portfolio, similar size, $500 million side portfolio. And then I went to a family office where I managed all of their natural resource business during a transition within their business, as well as all their third-party asset management. So with me and with some of the team that I've built on my side, we have an incredibly risk-centric focus to our business, which you really don't see in A, junior companies, and B, in junior resource companies. The second part of our team it's going out and getting the skill sets of best in class to be able to deliver projects. So our chief legal officer is ex-McCarthy's. My business partner, who is the president of our business, is a ex-CEO of a $1 billion plus enterprise value public crypto miner prior to this. So we've got lots of experience in public markets, lots of experience governing public companies, lots of experience managing risk. And so for me as an ex-PM sitting across the table for many years from junior companies, that you sit there and you say, well, there's a great value proposition, but how do I really underwrite this? We went about building this business with how do we prove not to just ourselves as principals, but to our shareholders that there's really underwritability and knowability in what we're doing. And the proof's in the pudding. So we took this business public about 18 months ago, a little bit over 18 months ago. And in that period of time, if you comp it to most junior market businesses, and particularly most junior market resource businesses, again, I sat across the table from all these guys. They require further equity capital to get their project going. They're reliant upon equity capital to drive their business and to get to some optionality. I used to sort of joke they're liabilities at a level before they can be, until they become assets. Our business isn't that. So in the 18 months that we've been public, we haven't raised an extra dollar. We've gone from $50 million of having raised capital to allocating well in excess of about 80% of that to projects. We generate revenue. We generate free cash flow from our key project. And we have productivity expected in 2024 from our Rwanda project, which I'll talk about in a second, and in 2025 from our India ARR project. So, we think about duration a lot, and we think about turning our book and how we do that thoughtfully and in a well underwritten manner. Over that time too, not only did we not issue shares to fund our business and became a resource company that generates free cash flow, but we actually repurchase shares. So we used a construct in Canada called the normal course issuer bid. It allows you to buy back shares at market, and we've bought back a significant number of shares. So we're now south of 120 million shares. Our peak was about just south of 130 million shares. So when you put that in context, it's just, I think it is a very unique situation within junior markets. The portfolio itself, I think, is at the end of the day, the meat and potatoes of what we do. People are important. People are what drive our business. Our best assets walking in and out the door every day. But our portfolio is what, sitting on your guys' side of the table, is going to be underwritten and understood, particularly in a base case, and then believing in the fact that and understanding the fact that there's a repeatability in what we're doing. So if you take our portfolio, you can really bifurcate it into two buckets: household devices and afforestation. We have 2 household device transactions, one in Rwanda, one in Vietnam. So household devices are really simple. When you think about, call it 1 billion people on the face of the earth, which is I didn't know this before I got into this business, but it's an insanely high number, and it sort of makes you feel sad a little bit of a number. But that's still either cook over an open fire, use an open fire to boil their water to make it potable, or to cook their food. 1 billion people. That's a lot of people. So in those families, mostly in low economic density areas, there's no access to all of the niceties that we enjoy in the Western world. So what we do is we distribute them a clean cooking device. So the benefit and the clean cooking device uses the same fuel source that they're using now, typically woody biomass, so trees, but it just burns. It's really simple technology, but it just burns it a little bit more efficiently, and in many cases a lot more efficiently. So you're using much less biomass to make less BTUs, but those BTUs are focused in a way that you're getting the same utility, if you want to think about it out of the back end. That reduces the amount of carbon in the atmosphere. Really simple. These methodologies for projects like this have been around for the better part of 20 years. They go back to the Kyoto Protocol and the compliance markets, the CDM markets that came from that, and now pursuant to the VCM that's in existence right now, and will be part, in our view, and frankly, the industry's view, part of the offset portfolio as we think about how Article 6 and Paris Agreement is adjudicated. So our two transactions, and in Vietnam as well, we distribute water purifiers. So doesn't reduce the amount of wood you burn, it eliminates the amount of wood. Other than the carbon side, there's a really, really high level of SDGs that come along with these projects. And fundamentally, what you're having happen is families need to spend less time away from home. Big win. Parents need to spend less time away from their kids. Big win. Way less. There's a lot of incidents, terribly, of rape and theft when people are walking really far away from where they live to go collect firewood because they know people are going to go there. Really big win. Biggest win is one of the biggest killers in the world is respiratory disease, not cancer or COVID or AIDS, but it's respiratory disease from breathing microparticles from fires day in, day out. So you're reducing the amount of that fine particulate matter because you're burning less stuff, and the stuff you burn is burned more efficiently and thoughtfully. Again, super big win. People have kids around these fires. So in our 2 projects in Rwanda and in Vietnam, this is a business. There's a duality in base between a for-profit and for-purpose, but there really is that duality. So let's talk about the profit side. In Vietnam, we have, as I've said, we have Citibank as our off-taker. So going back to the conversation before around underwritability and knowability, we didn't want to just go out and do projects that we thought made a lot of sense, but the ultimate shorts in the marketplace didn't. So Citibank's our off-taker for our first 7.4 million credits. We've tied together as closely as we can in our public disclosures what our pricing is in there. It's a fixed price, but you can effectively. I walked you through some of the numbers at the beginning, and you can back into really, really quickly what our price is. And as I said, for the back part of our contract, we'll net in and around $30 million for the back end of that phase 1 of that project. In addition to that, out the curve, if you want to think about it, we have effectively a call option. So we have a right, but not an obligation, no capital intensity, to purchase credits. And those credits, as we stand right now in a quote unquote bad carbon market, without any kind of upside relative to Paris Agreement, those would be in the money. So, again, you're getting no value in the equity or anywhere even close, and you're certainly not getting paid for the optionality. In Rwanda, we have 7.5 million credits that we're effectively more of like a structured financier on. The first 2.2 at an indicative price, and I'm not saying that this is the price for anybody, but at an indicative one, because this is what we've put in our public disclosure. An indicative price at 10, we'd enjoy about 90% of that profitability of those credits. And on the first 2.2 million and on the back 5.3 million, we'd enjoy about 30% of that. So when you think about that in context in Rwanda, and we put about 10 million bucks out the door in Rwanda. So on all of our deals on the household device side have been structured with really short durations that we can turn our capital quickly, bring our value at risk to zero. And we did it with project partners in both Vietnam and Rwanda that had done it before. For those in the audience that are natural resource investors, everything is sort of brownfield, quote unquote, to us. They've distributed stoves before. They've worked with the local charities or women's unions to distribute. They've generated carbon credits. We didn't want to underwrite either in ourselves or other people somebody doing something for the first time. That just never made sense for us. And so that knowability and that underwritability was really important in that project and those projects in general. I made allusion at the beginning to the conversation around upside relative to Paris Agreement. There's a lot of technicality in what I'm about to say for a really short presentation, and for a lot of folks, the first time that they're hearing about BASE. But really simply, when you think about Paris Agreement, which is the multinational, multilateral agreement between 206 countries to reduce the world's temperature by it's the legislation from an international standpoint to make sure that we don't really mess up the atmosphere. If you want to go through the math, we can go through it afterwards. Put it really simply. Article 6, which you may read about in the news, is a really, really important part of that legislation is the wrong word, of that agreement. And that is the part of the agreement that helps adjudicate how credits go from one country to another country. So think about Paris really simply as cap and trade, but between countries, as opposed to a compliance regime within a country that forces companies to cap and trade. So within there, the question is, how do you get credits if I'm XYZ oil and gas producer that has a structural short in carbon, and I'm buying credits to offset my portfolio in the United States, in China, in a large industrial country in India? How do I know that those credits, if I'm buying them from Rwanda or Vietnam, how do I know that those credits can be included in the nationally defined contribution in the amount of the cap and trade of that country versus the cap and trade of the country that you've come from? It's really hard. Who's going to get to count it? So the countries can give what's called a corresponding adjustment that says, hey, I'm giving you a stamp, I'm giving you a passport that allows these tons to leave my universe out of my cap. You can use them elsewhere. As of today, we have one of the first corresponding adjusted credit projects in our project in Rwanda. On that project itself, we've been merchant. We invested in that project about 18 months ago, 18 to 20 months ago from where we're at now. And we had the ability to go out and seek off-takers, and we didn't. And the reason we didn't is that we had an incredibly strong view around the corresponding adjustment capability of that country. We underwrote and looked at so many deals in other countries, and we had a very, very strong conviction. And as I keep talking about underwritability, that there were the potential of CAs. Where CAs matter is that if you're an oil and gas company, you're a structural short in carbon. I keep picking on the oil and gas producers, but you're a structural short in carbon for whatever reason, and you're going to buy offsets. Having a correspondingly adjusted credit allows you to have certainty that that credit's not going to get pulled back in by the host country's government and say, no, that wasn't supposed to leave our borders. So if you have operations in that country that you're offsetting, that's really easy. But most of the time, where you think about where carbon credits are generated versus where they're consumed, where industry is versus where you either have density of low economic populations, you have the ability to plant trees in our instance, those aren't the same. So the ability to have that corresponding adjustment is really, really important, and there's an incredible follow through on price. So we've been merchant on that. We'll now that we have the corresponding adjustment, which we're really happy about, we're really grateful for, and we're really grateful to the government of Rwanda for the amount of time and energy and work that they put in. It's really they did we've taken a secondary role to our project partner Del Agua, who's done great work. But we're, both of them, it's very trailblazing and it's very necessary for the carbon world. But economically, when you sit here and say, well, hold on a second, I'm just learning about what a carbon is. The punchline means price is going to be a lot higher. That's good for us as a business. That's our household device part of our portfolio. The most recent transaction that we underwrote is a afforestation reforestation deal in northern India. So that means really simply, we're planting trees. We're planting, which is a good thing. That I have children now, and for me, helping, and this is the God's honest truth, like helping families that have children that are breathing smoke over their fire, or planting trees in a world that for my kids and our kids and going, like, I think that that's just a good thing. And I think that doing it in a business where that's duality of for profit and for purpose is really important. And you don't either have to be a charity and make no money, or just be a business and be profit focused. We get to do both, which is an absolute joy. Within our project, as I said, we're planting. We've committed low teens amount of capital. Our value at risk is much lower. I'd call our value at risk probably about $8 million, give or take, because we have certain CPs that need to be met within the project that totally de-risk it for that additional capital. We're planting 6.5 million trees. We'll generate about 1.6, 1.7 million credits from the planting of those trees. The volume of credits, if you think about the amount of credits I've talked about on the household device side, the volume of credits is way lower, but they're much more valuable because you're talking about sequestration, pulling carbon out of the atmosphere as opposed to just abating it. We've already had two. So we completed that transaction about 2 quarters ago. We've already had 2 unsolicited buyers come to us looking to price it and have a discussion. We're really interested in prepays. We're fairly uninterested in offtake on that one out the curve because it's effectively a 20-year project. And clearly, where we're trading right now, which is a great opportunity for those sitting in the audience. But if we're not getting a great PV in our common equity for it, I'm not that interested in offtake out the curve, but I'm really interested in prepay. We had a lot of line of sight on what the market would look like through our project partner, Value Network Advisors, VNV, who are, I'd say, the preeminent project developer within the voluntary carbon market. They have 19 producing projects. They have another 75 projects in the works. And so this project is really, really high quality, as evidenced by the fact that we're getting phone calls already. And it's effectively smallholder land, 5 hectare or less farmers. So this isn't big tracts of land that you're going out there and you're trying to do plantation farming on. These are farmers. The farmers are doing a lot of the planting themselves, not because it's free labor, but because they know their land. They know where they want to plant the trees. They know how, we help them on the specific species of trees plant. We also help them plant fruit and nut trees on the land. We help with irrigation. So they love it to help with irrigation. That's outside of the monsoon season. They love it because we're giving them a cash crop that's not tied to seasonality. With there is seasonality, but you have some smoothing because there's fruit and nut trees of what we're planting. And they love it because it keeps water in the groundwater with our trees as well. So really, really high quality projects. As we transition this business and as we think about the build within, step one for us is really thinking about abatements. If you want to think about it like a power producer, they're great projects, but you have to have the right mix, to us, and they're great economic returns. When I think as an investor across the returns that are available in the marketplace, if you think about our Vietnam project, we committed $20 million of capital. We've recouped 6 already. And as I've said, we're talking about another $30 million, give or take, over the next 12 to 18 months. Those are incredible returns. And with a very, very low chance of capital overrun, given the nature of the capital allocation. We're not naive though. There has to be an incredible right mix to do those projects. So we'll continue to do abatement projects, but we'll do them as and when they're available. The base load of our business will be ARR projects. And then as time goes on into technologies like direct air capture, we just don't think they're there yet. We're happy to pay 10 times, 100 times what they're worth right now in the marketplace to make sure that, again, there is, as I keep talking about here, there's underwritability in what we're allocating our capital and our shareholders' capital in the business to. The last thing I'd say, I think you can probably tell we're pretty passionate about this business. We're pretty passionate about the business in general, but also base carbon. We're big principals as well. Myself and my co-founder, Fulford, we've written big checks into the business. We'll continue to write checks. We've spun it out of a business, Avex Technologies, that I was a co-founder of. Abex is commercializing a fully DeFi LNG exchange and commodity exchange in Singapore. They actually today they got their full of good news for you guys today. They were granted their operating licenses by the Monetary Authority of Singapore, so for their exchange and their clearinghouse, which is really really exciting. I'm just a shareholder there. They're a big shareholder of mine. I'm a shareholder there, but we're very excited about that. So it's we've got a really powerful ecosystem of people. We've got a really pedigreed background of thinking about risk, and we've got a really cool portfolio and similar expected return deals. So.
Michael, sorry to interrupt. We're getting
Done.
close to time.
If you gave me 10 more seconds, I would have stopped talking for
Well,
you.
wonderful. Any questions from the audience? All right, Graham.
Can you just talk about how you source the projects or how competitive it is as you're looking at them, and then also talk about in terms of finding people to buy the credits on the other side?
Yeah, totally. So sourcing is sourcing's incredibly important. It's I think it's a black and white bar whether you can underwrite or not. But then the question is, do you have enough flow to put through your engine to be able to underwrite properly to find the best deals out there? So if you're just waiting for a deal to walk in and then you're evaluating it, I actually think you're underwriting, because I think that sourcing engine is really important. For us, what we've realized in carbon is that there's a lot of really really early stage projects out there that could be great, but I don't want the duration is really long. So we are working with developers that have done it before, and I think it's evidenced by our book. All three of our developers have developed tons of projects before. They're the ones spending small dollars, 50, $100,000 to get a project. It's really less about the capital, but more about the duration and the focus to get a project to the point where it's like, I'd call it lowercase b, but bankable. That's where we're really focused in this market. And I think that from a sourcing standpoint, there's a lot of, I'm very interested in the repeatability of all of our project developers. I'm not going to do a deal with a project developer, and we as a business aren't going to do a deal unless we think there's a lot of repeatability back to what they're doing, largely because we're underwriting them just as much as the project itself. So it's sort of like almost like a dual tiered sourcing model of sourcing developers, and then as a function of that, sourcing projects that they've proven up, to use some resource language, to a level of semi bankability for us. On the offtake side is way harder, but it's way more interesting too. So this is a market that is it will commoditize, but it's not commoditized yet. Think about it like oil, but with all of the differentials with oil, but there's no benchmarks and there's no curves, right? So and there's like 9,000 different differentials and specs and. So it's almost, think about like oil versus all of the ways a barrel can be cracked, and then all of the diffs on that, and just like it makes your eyes spin. But you don't have 100 years to adjudicate what that marketplace looks like and the financialization. So it's all equity finance. There's not a forward curve. That's really good for us in a way, because it gives our ability to price things is incredible. Where it's really bad is that from an underwriting standpoint, you can't go out and just wash and repeat off and over and over and over again. You got to be really thoughtful, and you got to be really thoughtful where you're using your ultimate last dollar equity risk and where you're using your sort of merchant capital, if you want to think about it. In terms of off-takers, again, I think about it more like an ecosystem. Instead of, we don't have a dedicated sales and trading effort. There's people that do that. We might think about partnerships with those people over time, but we can, without any ego, but there's not many boardrooms that we haven't either been in as a group or we can't be in as a group. So it's more around us having, I don't want to have to go out on every deal and source a buyer. That's an utter waste of time in our business and not where we have edge. Other people have edge doing that. So it's where do we have relationship within our ecosystem, and how do we partner with the parties, whether it be a developer that has some of those relationships or a firm that actually does that activity, and pay them a fair wage for their skills and services and risk, and just be out of that business. But for us, we have to have a hand in it right now until the market commoditizes just a bit more.
All right, Michael, thank you for your time. I think that's it for today.
Thanks, everybody.
All right, everyone. This is our last presentation for today. So again, thank you for coming, and we're so excited to have this conference today. So for our last presentation, it is from Aaron Ratner, Executive Director of Alternus and CEO of Clean Earth. Both of these trade on the OTC markets under the symbol ALTNF, as well as the OSE under the symbol ALT. So with that, welcome.
Okay, let's get started. We'll try to be efficient here with everyone's time since we're the last one of the day. Thanks for sticking around. I'm going to tell you a little about Clean Earth and a little bit about Alternus today, and then we'll wrap it up. So a bit about how we got here today. I'm Aaron Ratner. I'm the CEO of Clean Earth Acquisitions Corp. We're a $230 million special purpose acquisition company formed in 2021 to go out and merge with a renewable energy company and help bring it into the capital markets here in the U.S. My background is in sustainable infrastructure investing. I started my career at Generate Capital, one of the initial sustainable infrastructure funds here in the U.S., founded by Jigar Shah, who currently runs a $400 billion loan book at the Department of Energy. I left there, became a partner and the head of origination at another sustainable infrastructure fund that had been seeded by the late Julian Robertson. After 4 years of that, we looked at about $10 billion of deals, transacted on a few hundred million of them. I left. I became a developer. I worked on a $1 billion carbon capture project with Lafarge Holcim and Oxy, worked on a hydrogen project at the Edmonton airport, and then worked on a series of biogas projects with Tyson Foods and their slaughterhouses. After being a developer for a while, where I really learned about how all this stuff gets built and actually deployed in the infrastructure space, I went and helped form Clean Earth. We are a team of 22 people. Everyone's climate minded. Our chairman, Nicholas Parker, is actually the individual who coined the term clean tech 20 years ago. And so we're all very focused on climate and the energy transition. Alternus Energy, the company with whom we are merging, is a transatlantic commercial industrial utility scale renewable energy business. The company is domiciled in Dublin. It trades currently on the Euronext in Oslo, and we'll be doing a asset purchase where we acquire the assets from the Irish holding company and bring them here onto the Alternus was founded 7 years ago by Vincent Brown, who is the current CEO and chairman. The business started off in Eastern Europe and Poland and Romania doing, as I said, commercial industrial scale solar parks. Today, the company is in Eastern Europe, Western Europe, and the US, although as you can see from a recent press release, the business is transitioning a little bit out of Eastern Europe where the returns are a little higher. So where is the company today? Very strong revenue growth. It's a real business. One of the advantages of building utility scale solar projects is that you build the parks in fields in good geographic locations where you can site them close to interconnection into the grid. So you're not on a rooftop, you're not beholden to a building owner. At the same time, you're not so big that it takes you years to acquire the land, permit it, and then you're playing with the big multi-billion-dollar developers. So we're in a really nice part of the solar space from a strategic perspective. Being in the commercial industrial scale as well is really important for us because while we sell electricity into the grid, the buyers of our power purchase agreements are credit rated corporate counterparties. So these are corporate entities who've made public commitments to reduce their carbon footprint. They're buying clean energy. They're doing that from us off of the grid, which means we can provide a credit rating to our lenders on our offtake contracts. It also means that if for any reason those contracts have issues, there are other buyers that can buy from us off the grid. So right now, with what's happening with residential solar, what's happening with large scale utility solar, we're in a really nice part of the solar space. So great revenue growth over the last few years. As everyone knows, the solar space is growing exponentially. The International Energy Agency every 2 years puts out an estimate of solar growth, and every 2 years they underestimate it. You can see those curves over the last 20 years. So that we think will continue. We've got a great pipeline of projects. At the moment, we have 168 megawatts under operation. We are selling out of Poland. We made a public announcement about that. Eastern European was a great place to launch the company, but at the moment, we see much higher return on equity and return on executive time in Western Europe and the US market. So we've got a great pipeline. Excuse me. We have great, obviously, tailwinds. The Inflation Reduction Act here in the US is providing a lot of incentives for investors to come into this space, whether that's corporations, tax equity investors, banks. And then in Europe, there are similar programs that are coming into play that are really incentivizing people to develop in the space. We've got good EBITDA growth over the last few years. Companies have been growing very well. Solar companies in our space have
positive EBITDA growth. They have negative net income, but the EBITDA is great and growing. This year, we think we'll do about $15 to $16 million of EBITDA. Next year, we anticipate that multiplying. The transatlantic operations for us are also quite strategic. There are ways in which we learn best practices from developing in Western Europe and the US that are synergistic to us. And we have great development teams in Spain, Italy. We will look at projects in Greece as well. And obviously, we're doing some things in Ireland where we're home based. And the vertically integrated part of our business, I think, is another key attribute. So we have a development arm where we pick up projects. We start at a field, we build them, develop them all the way from designing and permitting them all the way through to construction and long-term ownership and operations. And what that means is we can control our pipeline. We have a lot of control over the pipeline. So we're able to forecast when these projects are going to go into construction and when they're going to be kicking off electrons with a lot of clarity. And that's important for our investors and our lenders. It also means that we don't end up in bidding wars for projects when they hit what's called ready to build. So, typically in the solar space, there's a lot of developers who will sell a project the second it's ready to break ground. Because we're a long-term owner operator, we don't end up in those bidding wars. And actually what's happening here, particularly in the US and Western Europe, there are a lot of situations where the seller of land or the entity that's looking for a solar developer to come in would much prefer it's the same entity for the next 20 years versus someone who's going to come in and opportunistically sell that project to somebody else 12 months later. So the continuity of relationship with the landowner, particularly when you're buying from municipalities or wealthy families and landlords, is really, really valuable. And then, of course, we have a really proven commitment to ESG, which I can talk about later. So how big is the solar market? Everybody knows it's enormous and growing rapidly. It's still a very small fraction of the global energy supply, but we all know that we can power our planet with solar energy once we build the panels out and we build the infrastructure. In both the US and Europe, the forecasts are tremendous. These are trillion-dollar markets over time. Technology continues to improve on efficiency, which is the ability of a solar panel to capture sunlight and turn that into electrons on the grid. So the technology is getting better and better over time. We are totally technology agnostic. We work with equipment providers across the globe. We try to, obviously lower our CapEx costs, and we have great relationships with our suppliers. The equipment side of this business is effectively going to be an arms race to the lowest common denominator. So we try to stay away from owning any equipment providers or having any biases there. So the costs of CapEx are going way down. Even there's a lot of onshoring of production in the US that will happen in Europe as well. So there'll be more control over supply chain. And then, of course, on the other side of that trade, there's a lot of incentives for investors to be investing in these projects, whether it's tax equity or just senior bank debt. We can go into the Inflation Reduction Act a little bit here in the US. It's really a generational market opportunity. The Department of Energy has done a great job deploying capital. The tax credit regimes are in place and should be in place for 10 to 20 years, which provide a lot of clarity to developers and investors on the benefits investing in these projects. We think this will only continue, particularly as job growth starts to evidence itself around the country, where you have people in rural areas picking up long-term stable jobs from being involved in renewable energy. Similarly, in Europe, the programs over there are equally effective. There's a lot of job creation, and there's a lot of projects going into the ground, particularly in countries that have great solar footprint, like Greece, Italy, and Spain. So a little bit on the business model of Alternus. As I mentioned, it's a fully integrated vertically business model, and that provides a lot of advantages to us. So it reduces our CapEx costs over time because we control the construction. We're able to order equipment at scale, which gives us economies of scale on pricing and delivery. The business grows from a very early stage, so we have a lot of continuity on our pipeline, and we're able to be very clear with our investors and our lenders about the way and the schedule of deploying capital. So an example of that is last year, we secured a 500 million euro credit facility with Deutsche Bank for projects in Europe in construction or operations. The markets have been very choppy. We have yet to deploy that. We will begin to deploy that after we conclude our merger next week. We've got great access to construction and operating debt. And because we're bringing these projects up alone, on our own, we also control the scheduling, which is actually quite difficult. So what is the long-term business model? The business model really is how you recycle your equity. So you get in early and you deploy equity to start developing the projects. Those projects begin to become more valuable as you advance them through the development cycle. And eventually you get to what's called ready to build, RTB, break ground, build the project.
The size of the projects that we work on generally can complete construction in less than 12 months, which is really advantageous for refinancing between construction finance and long-term debt. These projects start to kick off electrons when they actually reach operations. In a lot of geographies, you can refinance that construction debt and actually take off over 100% of the equity that you put in, because the loan to value at that point is higher than the equity that you invested. And so you start to create a bit of a flywheel there where you're recycling your equity at very high net present value. Alternus has a proven track record of delivering. It's a great execution team. As I said, they're based in Dublin, but they have people here in the US, in Western Europe. The Eastern European projects also perform very well. They've been growing over the last few years, and we expect them to continue to grow into the future, particularly once we're NASDAQ listed and have better access to capital markets. This is our future growth plan. What it shows is what's operating today, what we're targeting to acquire. We have one of the things, as many of you will know about trying to go public, is you have to sit still and not close any deals, because if you move your balance sheet around or the value of your company around, you have to go through another cycle with your auditors, accountants, and the SEC. We actually thought we would be done with our process in the second quarter of this year. So we had a 6-month delay there, but we're finishing next week. We're through all the approvals, just waiting for the NASDAQ to sign up. But this is our pipeline. We'll be announcing a lot of projects next year. We'll be acquiring some operating projects. We'll be announcing a lot of development projects that we're getting involved into, both, as I said, in the US and Europe. And where we think we get to over time is about 3 gigawatts in 5 years. And at 3 gigawatts, then the business gets on what we call a perpetual flywheel. And at that point, is very, very equity efficient. Company's got great ESG credentials. Everybody's seen these metrics. This is the spirit of the business. Everybody who works at the company cares a lot about the environment. The projects that we work on are meaningful to the grids that we're plugging into, and people make this at Alternus, it's their life mission. So the work really matters to folks, and that's been obviously really helpful to us in what's been a challenging market. We've got a great experienced leadership team. Vincent is the chairman and CEO, bought the company, bought a few projects from some developers very early on. Our CFO has got tremendous experience in the space and has done billions of dollars of transactions. Chief legal officer's also got a lot of strength in the sector. So we've got a lot of people who come at this with a lot of experience and have been working together for a long time, which is really important. So, what are the numbers looking like? We're growing really well. The business is growing on all metrics. EBITDA is growing, revenue is growing, megawatts are growing. We expect this to continue. We think getting listed here in the US and hopefully turning a corner in 2024 and the world taking a deep breath could provide a lot of upwind for us here in the US and also Western Europe. The objective, 3 megawatts by 2026, that's our target. We are going to do that through acquiring development rights, acquiring projects in development, and acquiring potentially some operating assets. These will be, as I said, utility scale solar and storage projects. We may look at some microgrids and others, but we're really staying in our lane. We think that there's enough to do that we have expertise and that we don't have to stray into other technologies. And certainly, we'll never take any technology risk. What we're trafficking in right now is proven technologies, proven systems that the grid operators will be very comfortable with when we start plugging them in. This is one of the most important parts of the business. It's a very equity efficient model, as you all can imagine. The banks are loaning to solar storage projects. There's tax credits, as mentioned, particularly with a lot of the wind in the US coming offline or wind projects backing up. There's an abundance of tax equity available. That's really advantageous to us. Our business model at the moment requires us to raise about $65 million over the next 12 to 18 months of non-senior debt in order to hit a point where we never have to raise equity again unless we do it for growth. So our number is $65 million, 12 to 18 months. We'll do that through a variety of capital facilities that we put in place post going onto the NASDAQ, as well as next year as the stock settles and the world turns around and everybody, a little bit of friction comes out of the market, hopefully. That number gets us to about 750 megawatts developed and deployed annually, which puts us on trajectory to be a very successful multi-billion-dollar market cap business over time. This is our, what the business looks like. As I said, EBITDA positive growth. There's, shows a net income loss, but this is standard for the industry, and we will eventually get to a point where we're very cash flow positive. That's sort of the presentation I have for today. Just to review, we're in a really great part of the solar space. The utility scale C&I space is great from an execution perspective and a counterparty perspective. We've got a great team of people who've been working together for a long time. They know each other well. They've been through a lot. They're going to be very successful when we get on the NASDAQ. We're a proven business model. The equity efficiency has already been evidenced. We've sold a project that we didn't put any equity in at one point. So we know we can do it, got positive EBITDA growth, and of course, being listed in the US and focusing our efforts on the US and Western Europe is going to improve the return on equity and improve the return on executive time as well. With that, I will conclude the presentation. Be happy to answer any questions.
Thanks. So when you look at projects, usually there's some advantage, right, that a developer has, whether it's smaller, inefficient projects that the big guys aren't getting up from behind their desks to look at. What would you say is your focus that gives you an advantage to identify this, and what larger scale being highly commoditized, cost of capital? What's your niche in this, if you want to call it that?
I think our strengths there's a few of them. One of them, the team that we have has a lot of experience closing deals. So we're very efficient at getting to yes or no quickly. And in this business, you can build a reputation for saying no, because it's not going to be a good fit, and letting someone go somewhere else. And that's really valuable, because a lot of developers who are living on hand and fist and having trying to be entrepreneurs in the space, they need investors to close the deal. And if investors are treating it like an option and not actually closing or dragging their feet, it's a real problem for developers. So when you have a reputation for either being very clear with the development community, when you know what you're going to do and what you can't do, people will seek you out and give you a look at the project. We also have very local teams. So we have a team in Spain, a team in Italy, got a team in South Carolina, a team spread around the US that we're building out. And you also need local people, right? If you want to plug into the grid, you need to know the grid operator. You need to know the guy who services the base station, right? The substation. You have to actually know the people involved, because all of this, and this goes for the entire energy transition, it's a physical infrastructure revolution going on here. It's not software. It's not, you just don't put it up on the internet and hope it works and you take it down if it doesn't. I mean, you go to build this stuff, it has to work right. So there's a lot of people who work in this space whose day jobs depend on these technologies working. And when they don't, those people suffer. And so it goes back to my point about really staying focused on technologies that work. So we have very locally deployed talent. We have people who know what they're doing. My experience in project finance, our CFO's experience in project finance, we really understand how to put these things together in a very equity-like model. And then I would say also, in the more of the soft science, it turns out that developers with an Irish accent are very competitive in the market. For some reason, they just run around the US and win a lot of projects. We've had great success in Texas and the South, certainly more than I ever with the accent that I have coming from the Northeast.
Aaron, some questions came in from the online audience. The first one was, if you can speak to the timing of getting up and trading on NASDAQ?
Sure. So the Clean Earth acquisitions, that is trading today. It's CLIN is the ticker. We are through SEC approval. We are submitting our final NASDAQ forms. We expect to close next week, have the ticker change towards the end of the week. So we're a week away from executing on that.
There's a couple questions that came in asking for you to elaborate on some company statements.
Sure.
So one of those is asking about how do you see the impact of the Inflation Reduction Act, and how fast do you see that impacting your financials and prospects?
Well, I think the broad effects of the Inflation Reduction Act are already occurring in the American economy, right? It's creating jobs. It's incentivizing utilities to do more in the renewable energy space. The banks are lending. Obviously, interest rates have gone up. That's been painful. We would not be making such a big push into the U.S. if we didn't have deep conviction in the enduring strength of the Inflation Reduction Act and the programs that the Department of Energy are putting to use. That facility we have in Europe, the facility with Deutsche Bank, 500 million euros. We're going to try to replicate something similar here in the U.S. with an infrastructure bank, put that in place, and we continue to think that. Over time, by about 2025, a majority of our EBITDA will come from U.S. projects.
And can you comment, I guess, on your ability to earn much greater returns for the same amount of equity deployed in the future?
Well, greater returns than what? Than our business in previous years, or
Yeah, I think in
or-
previous
yeah.
years. It's about looking forward.
Sure.
And
Yeah, so I think our EBITDA margin will improve over time as we scale up the projects that we're doing. You know, you get economies of scale from ordering equipment. You get economies of scale from doing repeat projects with the same utility, for example. So just as efficiencies increase and we get a little bit bigger, I think we'll have a bit of margin improvement over time.
are there any other questions for Aaron? Right. Thank you, Aaron.
Thanks very much for having me.